Huh. The board press release. Calendar. Here we are. Today. Beach voice chair. Today's the 24th. Oh, watch live. Here we go. I found it. There we go. All right, I'm going to watch him speak live. Oh, wow, they have a miss. Oh, and no, it is Tuesday. That was Wednesday. Good morning, everyone. Good morning to everyone on the live stream. We're going to be watching Jerome Powell talk in about 4 minutes. He should be speaking. All right, no fair value gaps yet. Good morning, everyone. Good morning. In 4 minutes, we're watching Jerome Powell speak. And will he cut rates this morning or talk about it? Will he talk about cutting rates? Especially after the ceasefire that happened yesterday, the market on Nasdaq is looking extremely bullish. Asia session ripped up, London session ripped up, and so hopefully New York session can continue that. I would expect some volatility when he speaks, maybe to the downside, to London low, and then hopefully we can tap into London low, get an ILM, and then we ride that to potentially all-time highs of the Nasdaq, which would be awesome to be able to hit all-time highs today. It's very possible. We are very close to all-time highs. All right, he speaks in 3 minutes. 3 minutes, and then we're going to be diving into see what he does. Two minutes. Let's see. There it is. We'll kind of do a split screen here, so if I can get hopefully have the charts off to the right hand side of the screen so you guys can see it, and then also have him be the main. There you go. Should be beginning shortly. Once this starts, I will be kind of muting my mic and then turning up the desktop audio so you guys can hear him talk, and I'll shut off the music that's going on in the background too, and then we can check out what Powell's gonna say today. Oh, view on YouTube. Oh, here we go. Oh, here we go. Here we go. This is what we want. There we go. That's better. All right, you should be on any minute now. It's supposed to start a minute ago, but sometimes these start like up to 5 minutes late, so we'll see. But it should be starting any minute, and we'll watch him, and then hopefully catch a really good trade. Because when Powell speaks, there tends to be some volatility, and we'll just wait for our model to play out. We're not going to do anything other than what our model allows. But if we get, hopefully we get a model set up and we can take a really good trade today after he speaks and after he potentially says some good things. We'll see what he says today. Morning, everyone. I see we're getting a lot more people in here. We're about to watch Jerome Powell speak on his the semi-annual monetary policy report, which is pretty big news for the market. And this is something, if you're a day trader right now, if you have your charts open like me, be very careful here. Be patient. It could be very volatile. All right, I'm gonna mute.
Committee on Financial Services will come to order. Without objection, the chair is authorized to declare a recess at any time. This hearing is entitled the Federal Reserve Semi-Annual Monetary Policy Report. Without objection, all members will have 5 legislative days within which to submit extraneous material to the chair for inclusion in the record. I now recognize myself for 4 minutes for an opening statement. Good morning. I want to thank Chair Powell for joining us today. We appreciate your time and look forward to hearing more about the Federal Reserve's outlook on economic and monetary policy. There's been a lot of rhetoric lately, particularly from our friends across the aisle, suggesting that Republicans in the Congress are steering our economy toward a recession. However, the facts tell a different story. 4 months into the Trump administration, American workers and taxpayers are already benefiting from a strong, resilient economy. The Fed noted that growth is solid, and even former Fed officials have dismissed the idea of a recession this year or is near. Compare that to the previous administration. Under President Biden, Americans endured the highest inflation rates in decades, driven by reckless spending and misguided policy decisions. Now, under the Trump administration, inflation has declined to levels lower than those seen before President Biden's flawed so-called American Rescue Plan, and real wages are finally meaningfully growing again. There's always some economic uncertainty when the United States engages in difficult negotiations necessary to secure more open markets for American goods and services. But that uncertainty is not without a strategy of balanced lower regulatory costs, pro-growth tax policy, and controls on federal spending, all combined with trade successes, offer economic opportunity. One Fed official, Governor Waller, has outlined how a balanced approach combining potential tax rates with targeted tariffs could foster strong economic growth. Let me be clear on that point. We can fight to open markets, break down non-tariff barriers while achieving solid economic growth at the same time. That's President Trump's goal, just as it was for President Reagan in the 1980s. I also want to commend you, Mr. Chairman, the Federal Reserve, for taking positive steps to keep politics out of the Fed, including disbanding 4 internal climate-related committees and making the Fed leaner and more efficient by right-sizing your workforce across the system. These moves reflect a commitment to efficiency at the Federal Reserve. I'm also pleased that Governor Mickey Bowman has been confirmed as Vice Chair for Supervision at the board. Governor Bowman has been a tireless advocate for community banks, and this committee is eager to work with her on policies that enhance our bank's ability to provide greater access to capital and services for our families and businesses across our nation. I look forward to today's hearing, and I yield back the balance of my time. I'll now recognize Mr. Foster on behalf of the ranking member for 4 minutes for an opening statement.
Thank you, and I will save everyone a little bit of time. Ranking Member Waters was unavoidably detained. I'll just say a little bit that the markets have kind of spoken on their confidence in the Trump economy. Probably the single simplest metric of that is that the U.S. dollar is down roughly 10%. Okay, this is not a small thing, and it has caused countries around the world to question the primacy of the U.S. dollar going forward. This is one of the worst market responses, I think, to the chaos that we're seeing, the tariffs that are very destructive to international trade, and just everything that the markets are seeing and trying to suffer through. I know I'm contacted all the time by businesses in my district, manufacturing businesses that can't even start thinking about investing with the level of chaos just from the tariff policy alone. Anyway, there's a long set of things we should be talking about, and I'm happy to save some people some time, and let's get to it. Yield back.
Gentleman yields back. I recognize the Chairman of the Task Force on Monetary Policy, Treasury Market Resilience, and Economic Prosperity, Mr. Lucas, for 1 minute for an opening statement.
Thank you, Mr. Chairman. Today's hearing will allow us to evaluate the state of the economy and review the FOMC's policy decisions. It's appropriate to regularly take a step back and assess the central bank's performance and its responsiveness to the economic conditions our constituents face back home. This hearing is particularly timely conversation as the Fed wraps up its 5-year framework review, including a thorough look at the consensus statement, communication strategy, and other guiding policies that will have a profound effect on the lives of every American. Many of these topics we'll discuss today we've taken a closer look at in the Monetary Policy, Treasury Market Resilience, and Economic Prosperity Task Force. I look forward to building on these conversations here. One issue that I think warrants special attention is the binding nature of the SLR and ESLR on the Treasury market intermediation. I'm glad to see the Fed is looking into this tomorrow, and I hope we'll see meaningful action soon. Chairman Powell, thank you for being here. It's critically important that Congress and the central bank have an open dialogue. Transparency, accountability, honest communications are pillars of our system's success. I look forward to your testimony on the state of the economy and the Fed's plans for the future. And I yield back, Mr. Chairman.
Gentleman yields back. I recognize the ranking member of the Task Force on Monetary Policy, Treasury Market Resilience, and Economic Prosperity, Mr. Vargas, for 1 minute for an opening statement.
Thank you very much, Mr. Chairman and ranking member, and thank you, Chairman Powell, both for your years of public service and for being here today. Since 1977, the Fed has been tasked by Congress with its dual mandate goals of achieving both maximum employment and stable prices. Unfortunately, this administration has made accomplishing these goals more difficult. In the Fed's most recent summary of economic projections, we see a forecast for slower growth, stickier inflation, and rising unemployment, all of which point to a potential stagflation scenario. Whether it's the president's indecision on trade policy, his hiring freezes impacting the collection of economic data, his ballooning of the deficit to cut taxes for the wealthy, or his name-calling, all of these actions make it tougher for the Fed to do its job. I look forward to your testimony today, Mr. Powell, Chairman Powell, and I yield back with that.
Gentleman yields back. Today we do welcome the testimony of the Honorable Jerome Powell, Chair of the Board of Governors of the Federal Reserve System. Chairman Powell, we thank you for taking time to be with us. You'll be recognized for 5 minutes to give an oral presentation of your written testimony, and without objection, your written testimony will be made part of the record. You're now recognized for 5 minutes. Mike.
Thank you, Chairman Hill, Ranking Member, and other members of the committee. It's great to be back here today. I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. The Federal Reserve remains squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer-run objective. We are attentive to the risks on both sides of our dual mandate. I will review the current economic situation before turning to monetary policy. Incoming data suggests that the economy remains solid. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were driven by businesses bringing in imports ahead of potential tariffs. This unusual swing has complicated GDP measurement. Private domestic final purchases, or PDFP, which excludes net exports, inventory investment, and government spending, grew at a solid 2.5% rate. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a decline in sentiment in recent months and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged a moderate 224,000 per month in the first 5 months of the year. The unemployment rate at 4.2% in May remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. The strong labor market conditions in recent years have helped narrow longstanding disparities in employment and earnings across demographic groups. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total personal consumption expenditures, or PCE prices, rose 2.3% over the 12 months ending in May, and that, excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up over recent months, as reflected in both market and survey-based measures. Respondents to surveys of consumers, businesses, and professional forecasters point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. With the labor market at or near maximum employment and inflation remaining somewhat elevated, the Federal Open Market Committee has maintained the target range for the federal funds rate at 4.25% to 4.5% since the beginning of the year. We've also continued to reduce our holdings of Treasury and agency mortgage-backed securities, and beginning in April, further slowed the pace of this decline to facilitate a smooth transition to ample reserve balances. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Policy changes continue to evolve, and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It's also possible that the inflationary effects could instead be more persistent. Avoiding that would depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you, Mr. Chairman. We'll now turn to member questions. I recognize myself for 5 minutes for questions. Over the past few weeks, our Democratic colleagues have suggested the following. After the initial release of the GDP report, the president is driving the economy into a recession. Chairman Powell, the latest FOMC statement described economic activity had to continue to expand at a solid pace, and you just reiterated that in your testimony this morning. In your view, is the term recession and the economy growing at a solid pace, are those synonymous with each other?
I would say no.
And you note that the labor market continues strong, the economy's at a standard pace, and you also referenced in your testimony that that first quarter GDP initial react was also from front-end loading, as you noted, imports to try to avoid tariff impacts. Also, I looked at the Atlanta Fed GDP Now model, which forecasts GDP growth for the second quarter of this year at nearly 4%, with core GDP forecast at 2%. Does that Atlanta model suggest a recession to you?
No, I would say it doesn't.
So in looking at your remarks about tariffs today and then the ones that you made during March and April, I was looking back at a Fed study that noted that up until March, tariffs have already been partially passed through in consumer prices, leading to a contribution of merely 1/10 percentage point increase in core PCE prices. And a Harvard study last week showed that prices have only modestly adjusted since the announcement of tariffs. Finally, the longer-term inflation expectations remain consistent with the 2% goal. Governor Waller laid out a pathway that allows for rate cuts provided that average effective tariff rates remain close to 10%, or I assume he means 10% or lower. The labor market remains solid, prices continue to disinflate. So given that data I've outlined, I'm sure data that you're very familiar with, for the economy to avoid persistent inflation, do you concur with Governor Waller that there is a pathway for good news as it relates to the regulatory policies, the tax policies that I've discussed, in a world with lower tariff rates?
So first, I wouldn't comment on any other FOMC members' comments one way or the other, but I will say this. I think many paths are possible here, and certainly the one you mentioned is a possible one. We could see inflation come in not as strong as we expect, and if that were the case, that would tend to suggest cutting sooner. We could see the labor market weakening, and that would also suggest cutting sooner. On the other hand, if we see inflation coming in higher, or if the labor market were to remain strong, then we would probably be moving later. So I think a range of possible paths are possible, and certainly the one you mentioned is one of them.
In February of 2021, you told us in this committee that you would stay in your lane and not comment on President Biden's proposal for the American Rescue Plan or sharply increasing federal spending. And, you said it was an issue, but that you would stay in your lane and not comment on it. But here in this year, you have commented on this idea of tariffs being set by the executive branch. So are tariffs in your lane, but a huge fiscal spending by the Biden administration not in your lane? Explain to the committee why you chose to be silent in February of 21, but outspoken this spring.
Sure. So we haven't commented, and it would be inappropriate for us to comment on the policy of tariffs. We don't have a view. It's not our job, and we just wouldn't do that. And just as we wouldn't comment on the reconciliation package that you're working on right now. We're not commenting on tariffs. What our job is inflation, keeping inflation under control, and also keeping maximum employment. And when policies have what appear to be short and medium-term implications, meaningful implications for that, then they kind of, not the policies themselves, but the inflation becomes our job.
Yeah. You know my views on price stability. I think it's a first among equals in your dual mandate. I've argued for that. I've introduced legislation to make the dual mandate the sole mandate, and we've talked about that before. But I was very curious about your thoughts on former president of the Cleveland Bank, Loretta Mester's quote that I read from last fall. She says, "I think that maximum employment is the maximum level of employment consistent with price stability." In other words, she elegantly ties that together, that price stability is what you can have more control over rather than, all these other factors that enter the employment picture like legislative and executive branch. What's your thought about her quote?
I personally think that's a very reasonable way to think about it.
Thank you very much. I yield back. The gentleman from New York is recognized for 5 minutes.
Thank you, Mr. Chairman. Good morning, Mr. Chair, Chair Powell, and thank you for being here. Last week, the FOMC decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. While I was not surprised by the decision to hold rates steady, I was surprised by the committee's revised forecast since March, which represented a decrease of 0.3 percentage points for GDP, a similar increase for core PCE, and an uptick in the unemployment rate to 4.5%. Can you explain the incoming data that the committee has seen since March that caused it to make these adjustments?
Sure. So, first of all, these are individual. This is not a committee forecast. These are just individuals submitting their own personal, forecasts, and we don't bless those as a committee. But I think people are looking at the incoming data and having a range of different judgments. If you look at the range, if you look at the central tendency, you'll see that it covers quite a wide range. Those are the medians that you're talking about. I think so. Inflation is projected to have moved up because of what we've seen, particularly from tariffs. And I think if you look at other outside forecasters, you'll see very much the same thing.
And what data are you looking for?
Well, we look at the incoming data on. We look at our own forecast and we ask ourselves what's likely to happen. Monetary policy has to be forward-looking. A forecast is a prediction of what's going to happen in the future.
Thank you. In its statement, the committee announced that it will continue to monitor the implications of incoming data and adjust the stand of monetary policy as appropriate. Some analysts predict 2 rate cuts by the end of the year are still on the table. Is this a fair and accurate assumption? And what incoming data will the committee need to see to consider these cuts?
So what will actually happen with rates is going to depend on the path of the economy, and that's highly uncertain. So I would just say what that means at this moment in time is that a significant majority of the committee, but also there's a pretty significant minority that doesn't agree, but a significant majority feels it will be appropriate to reduce rates later this year. And what that means is that each of those persons who wrote down a cut in rates later this year, they think that there's some state of the world where inflation doesn't prove to be as high, or the labor market weakens, or some combination of those two things, that it will turn out to be more likely than not appropriate to reduce policy rates, subject to great uncertainty. I mean, we will, the story has been evolving, and our thinking has been adapting, and that will continue.
Thank you. Chair Powell, although a ceasefire has been tentatively reached in the Middle East, the situation still has the potential to open global and energy markets, especially if the ceasefire is broken, while at this point Iran is seen as unlikely to close the Strait of Hormuz. That decision could change. How is the Fed assessing the current situation and incorporating those assessments as it considers future adjustment to economic projections and its stand on monetary policy?
So I think it's too early to know what any economic implications might be, and I would not want to speculate like everyone else, we are, of course, watching the situation.
Thank you. And Chair Powell, after reviewing the economic data following the meeting last week, it seems to me that the committee is indicating that we could be headed for a situation where inflation accelerates while unemployment rises and growth become more sluggish. In this scenario, this will put the Fed's dual mandate of maximum employment and price stability in tension with one another. In this scenario, how does the Fed balance these priorities in order to achieve both mandates?
So let me say that we're not facing that right now, and that isn't really our forecast that we will face such an issue in a serious way. But if that does happen, then what we do is we look at the two goals and we see which one of them is farther from its goal. Two variables, is maximum employment or price stability farther from its goal, and we prefer the one that's farther than its goal. And then we also ask ourselves, how quickly will they return to goal? It's a very difficult situation for any central bank, and I would say again, we're not in that situation right now.
Thank you, Mr. Chairman. Yield back.
The gentleman's time has expired. The Vice Chairman of the full committee, Mr. Heising of Michigan, is recognized for 5 minutes.
Thank you, Chair Hill and Chair Powell. Good to see you again. I got a lot to cover, so we're going to try and keep this concise. But following up a bit on what Chair Hill had been talking about, you had said in January 29, 2025, quote, "We don't know what will happen with tariffs, with immigration, with fiscal policy, and with regulatory policy." I would add energy into that, by the way. "We need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be. This is no different than any set of policy changes at the beginning of the administration." However, December 18 of 2024 at the FOMC press conference, you noted, and I'm paraphrasing, that some Federal Reserve officials began to incorporate preliminary conditional estimates of how fiscal policies might impact the economy into their forecasts. This seems inconsistent, and I sidebarred with the chair to say, okay, did I hear this correctly, his question and sort of your answer? What I heard is that there was a belief that the IRA would not be inflationary, but that tariffs could be. Therefore, suddenly you and others were commenting on tariffs. And for the institution, I know you try to be consensus-driven. Why are there FOMC participants making fiscal policy assumptions into their forecasting when you yourself said that fiscal policies need to be articulated before the FOMC can make a plausible assessment into their implications, what those will be? And I think if there's different participants having different assumptions, that would render the SEP, Summary of Economic Projections, biased, meaningless, useless, less impactful, and when you're not comparing apples to apples. So wouldn't it make more sense for all the forecasters to make the same fiscal policy assumptions at the same time? Or if not, shouldn't each participant disclose what assumptions that they're using and building into that? So here's the question.
So that's a great question. That really, when the Summary of Economic Projections was originally designed and put into effect in this way, the way it works is that individuals are free to make whatever assumptions they want, and they do disclose them. They disclose them in their speeches and things like that. So there will be situations where some people incorporate something and others don't, and we try to be transparent about that. But that's kind of the way it works. When I say we don't take it into account, I'm really talking about policy and the committee as a whole, where we won't take things into account until we know.
And you believe that the participants disclose their assumptions when they're doing their forecasts?
Well, I think they do that in their speeches. Each people go out. You may have noticed there are a lot of speeches.
Well, I guess the opaqueness of the Fed has been something over the arc of my 15 years on this committee has been one that has been debated greatly, including auditing the Fed and a number of other things that have gone on. I've got here a brief moment. I do feel like I need to touch on interest rates. Not to be a shock, you asked how the family business was doing back in Michigan. Families involved in sand and gravel and aggregates and construction and things like that. It's been strong. We need more labor. We need a few other things on that, what's happening. But I mean, I think there's no recession. That's been established. There's no hyperinflation, or certainly not as what some had been projecting. Yet there seems to be higher than expected or certainly desired interest rates for many of us. And I'm curious how high interest rates, they hurt Americans who are paying car loans, credit cards, mortgages. You had FHFA Director Pulte asking for lower interest rates, which would obviously impact home buyers as well. So what is it that's keeping, in your mind, the Fed from what many of us believe is the right thing to do, which is to lower some interest rates, and by the way, match what the Bank of Canada, Bank of England, the European Central Bank, the Swiss Central Bank, a number of emerging central banks. By the way, that's your own assessment on page 33 as where you're laying that out. Why aren't we doing what the rest of the world is doing? Is it because we're at full employment? Is it because of those tariffs concerns that you said weren't part of the analysis? Was it energy, groceries, durable goods? Why?
So you're right that if you just look in the rearview mirror and look at the existing data that we've seen, you can make a good argument that that would call for us to be at a neutral level, which would be, a couple of cuts or maybe more kind of thing. The reason we're not is the forecast by all professional forecasters that I know of on the outside and the Fed do expect a meaningful increase in inflation over the course of this year. When I said we weren't going to talk about tariffs and inflation, that was to say until we see what the policies are. And so now we know a lot more. It's 6 months since I said that. So anyway, I'd be happy to continue this with you.
Thank you.
Gentleman's time has expired. Gentleman from Michigan, Ms. Tlaib is recognized for 5 minutes.
Thank you so much, Mr. Chairman. Chair Powell, last month there was research published in the Journal of Urban Health that found that more than half of Black women of reproductive age, that's the term they use, in the counties that I represent, that had experienced some sort of eviction during their lifetime. So that's like 50% of Black women in the two largest counties, Wayne County and Oakland County in Michigan. And these numbers are horrific. As you know, were you aware of that?
No, I was not.
And evictions are often very traumatic experience, but also it creates a cycle of poverty, but also this instability for many families. But especially when it comes to a lot of our Black neighbors, the access to equity, the access to housing is diminished even more. In Michigan, we lost more Black home ownership than any other state in the country during the last recession. So we know the housing crisis, I believe, is structural, and some may say it's a policy choice. While there are many factors at play, and you know this, Chairman, high mortgage rates, the finance rates and so forth, that drag the supply of new housing. But last month, new housing hit a 5-year low. Are you familiar with that?
I'm not sure exactly what statistic you are referring to.
Okay, I don't know. There was all this articles about the housing market and the impact of tariffs and so forth, and they said, again, it hit a 5-year low. And again, I'm getting this from a source. But this sets the market up for higher inflation and more burdensome housing costs to years to come. So Chairman Powell, I'm looking at this monetary whatever policy framework that you guys have put together. Do you think that the way it's structured, and again, I'm trying to understand how you're looking at this in the housing crisis, do you believe it's eroding new rental supply under construction right now, leading to high inflation in future years?
So I think there are two things going on quickly. One is just there's a longer run shortage of housing in the United States, which there's nothing that the Fed can do about. That's not something we can affect.
Well,
there's also, if I may say, in the short run, rates are high, and that's going to weigh on housing activity. But the best thing we can do for the housing market, the absolute best thing, is to restore price stability so that rates come down and so that rates can be at a level that people can afford.
But don't you think that the restrictive monetary policy the framework you all put together undermines long-term price stability right now by reducing the supply?
No, I mean, I think
But
it restores price stability. The point of higher rates is to...
So you don't think the higher rates is impacting future supply of housing?
So I think what that does is, I think interest-sensitive sectors like housing are very much directly affected when we cut rates or when we raise rates. That's right. But that's part of the mechanism for restoring general price stability.
So keeping the high interest rates does not impact future supply of housing?
does not, over the long.
I need to go back to talk to
Over the long run,
women that the
the
study.
Fed will not be, our policy will not be a driver of longer run housing supply in the United
So,
States.
okay, let me ask you, what is the difference? And I'm honestly confused. I want to learn here, and I'm sure people listening to this want to learn. What is the difference between demand-driven rent inflation and supply-driven rent inflation? Like, you guys use these terminologies. What is that? How do I communicate that to the public? What is the difference between supply-driven versus demand-driven rent?
Those are not terms that we use particularly often.
What's
but
supply-driven formula?
that would mean that there's not enough supply to meet demand. But at the same time, it also means there's more demand than there is supply.
So are you guys ignoring that?
No, but as I said again, our policies will not affect in the long run.
No, I'm being
either
serious, 'cause
demand
I
or
see somebody
supply
behind
in
you kind of
housing.
I'm being serious, y'all. We're talking about a housing crisis that is getting worse right now because we're not paying attention to future instability that the current rates, and you can raise your eyebrows and all this stuff behind. I don't know. I mean, do you understand? Like, I come from a community right now that I believe is now being impacted by the current framework that you're putting together, that I do feel like it's going to be long-term effects on the housing crisis, and you're ignoring it.
No, we're not, actually. We think the very best thing we can do is to fully restore price stability at the aggregate level. That will be the best thing for homeowners and for home
Even though the
builders and
housing
everybody
supply
else.
has been
That's in
impacted
the
by the
long
high
run, that
interest.
is the single
But
thing
Chairman
that
Powell,
Congress
you
has
see where I'm
assigned us
coming
to
from.
do.
But you see where I'm coming from. It is impacting future supply of housing, right?
Not in the long run, no.
Okay, well,
Gentlewoman's
Mr.
time
Chair,
has
thank you.
expired. The gentleman from Wisconsin, Mr. Stile, who's also the chair of our Subcommittee on Digital Assets, Financial Technology, and Artificial Intelligence. You're recognized for 5 minutes.
Thank you, Chairman Hill. Thank you, Chairman Powell, for being with us today. I want to dive into two actions the Fed's recently taken to get a little additional color on. Yesterday, the Fed announced that reputational risk would no longer be a component in bank exams. I viewed that positively. I viewed the reputational risk as often being a catch-all for political bias. I think it's positive to depoliticize bank exams and instead focus on the core and measurable risks. Could you provide color as to whether or not any new information came to light that led to the decision of the Fed to remove that yesterday?
I'm not aware of any new information. No, we just think it's the right thing to do, and of course made an announcement on Monday under Governor Bowman's, Vice Chair Bowman's leadership.
Why would it not have been done previously if it's the right thing to do? I agree with you, it's the right thing to do. Why was it? Any timeline as to why that was done yesterday versus previously?
No, I think this is a problem that we came to understand as a problem over the course of the last couple of years, and began considering what's going on here. We're hearing a lot of reports of debanking and that sort of thing, and over the course of really 2024 came to the view that this was a serious problem that we need to address, and we've said that publicly, and now we're doing this, and so are the other agencies, by the way.
I appreciate you taking that action. I do agree that there were real political bias in some of those exams, in particular as it related to regulated entities engaged in the digital asset space. Let me shift into the digital asset space if I can. Another action recently taken by the Fed, the Novel Activities Supervision Program was ended and withdrew several statements on digital asset related risks that deterred bank involvement in particular. You in the Fed and others at the Fed have spoken positively about the House and Senate work to regulate stablecoin in particular, a real opportunity to dollarize the globe and be a significant purchaser of U.S. Treasuries. Following that action by the Fed, have you seen an identifiable shift in banks or other regulated entities as it relates to engagement in the digital asset space?
I wouldn't be the one to be picking that up first, but what I do see is a very significant change in the tone, and it really does reflect evolving thinking and the evolving status of the crypto industry, and I would expect over time we'll see more activity.
How is the Fed evaluating and overseeing banks or other regulated entities that are in the digital assets or crypto space?
So our view is that banks get to decide who their customers are. That's not our decision. And so banks are free to provide banking services to the crypto industry, to crypto companies, and banks are also free to conduct crypto activities as long as they do so in a way that is protective of safety and soundness.
Thank you very much. Let me shift gears because I want to give you just a little bit of an opportunity to comment on the housing sector once again, but give you a little freedom here to speak to that area. You correctly are trying to balance inflation and price stability, but also higher rates have a significant impact on the housing market as shelter and housing costs are a significant driver of why many families can't afford the things that they need. Could you provide color as to how you're analyzing the impact that housing and shelter costs have on families and on inflation with your desire to maintain price stability at the interest rates that is currently set by the Fed?
Sure. So, we realize that people are feeling high housing costs and high financing costs. In terms of inflation, we look at something called owner's equivalent rent and rentals, and that's meant to capture both rented housing and owned housing. And it's been very sticky. It's been one of the stickiest parts of inflation. I'm happy to say now it actually is coming down quite regularly. That's very good news. That's been the part, really it's been the service inflation that's been stickier than other parts of inflation. So that's good news for people, I think, and it is showing through into measured inflation now. Again, in the long run, the best thing we can do is restore price stability and let the market work. Even then, though, we're still going to have a housing shortage.
What data do you think is leading to the reduction in the rent equivalent?
I just think it took time. So the thought is when you would think that if rents come up every year, you would think it would take 1 year or 2 years for a lack of growth in rents to show up in a lack of growth in housing prices. It turns out it takes 4 years or 3 years. If you're an existing tenant, it's a complicated thought, but if you're an existing tenant, you don't actually catch up the way you would if new tenants came in. And so that's made the measurement of inflation stickier. But I'm happy to say we've been through that period now, and we are really seeing now housing services inflation pretty close to where it was when inflation was solidly at 2%.
Thank you. I yield back.
Gentleman yields back. Gentleman from California, Mr. Liccardo, is recognized for 5 minutes.
Thank you, Mr. Chair. Mr. Chairman, thank you for your testimony today. I appreciate that your dual mandate is full employment and price stability, and I appreciate your efforts on behalf of our country to achieve those. My understanding is that critical data is collected by the Bureau of Labor Statistics to help formulate the indicators that you rely on, that we rely on to understand unemployment rates, CPI, and other inflation indicators. We are certainly hearing a lot about the impacts of DOGE on our workforce, and specifically about the elimination of many of those positions in BLS. And now we have a proposal in front of Congress to cut $56 million from that agency. Are you concerned about the ability of your team to get accurate data and about the ability to have reliable indicators to make good decisions upon?
I wouldn't say that I'm concerned about the data today, although clearly there has been a very mild degradation of the scope of the surveys and things like that. But I would say the direction of travel is something I'm concerned about, and that is measuring the U.S. economy carefully and well is a project that's been going on, and we're getting better at it for 100 years and more. And it's really important, not just for the Fed, but for Congress and for businesses, frankly, to know what really is going on in the economy. What's happening? Is growth high? Is it low? And all those sorts of things. So I think it's a smart investment to just continually try to get better at measurement of what's happening in the economy. And I don't like to see that, the kind of stories I'm reading and the idea being that the data is going to become more volatile and less reliable. That'll make it more difficult for the private sector and for you and for us, and I don't like to see that direction.
I agree, thank you. I appreciate that it's not your role to comment on the advisability of specific policies, but given your critical role in ensuring price stability and reducing inflation, I have had conversations with, quite recently, just a week ago, with a C-suite executive of a major global retailer who informed me, because I asked, why aren't we seeing the impact of these tariffs and price data yet? And he said, it's coming in the third quarter, because it takes time for tariffs to work their way through a distribution chain. Often what you have on the shelf today may have been imported 2 or 3 months ago. Is that your understanding? Do you anticipate there may be impacts down the road?
Yeah, that's very much what I hear. I happened to meet with an unusually large number of business people in this last FOMC cycle, and that's a typical thing that they'll say, especially the retailers, that what's being sold now was in inventory in February, let's say, and it just isn't showing up yet. So we do expect to show up, tariff inflation to show up more, but I want to be honest, we really don't know how much of that's going to be passed through to the consumers. We just don't know, and we won't know until we see it. It could be lower than we expect. It could be higher. We have to wait and see, which is kind of what we're doing.
I appreciate the uncertainty. Another thing he told me that had me very concerned was that often they will increase prices on goods not subjected to tariffs to compensate for the very substantial losses they have to suffer with the increase of tariffs on relatively price elastic goods. So in other words, necessities will also tend to bear a higher price even if they're not subjected to tariffs. Is that your understanding of the potential impacts?
You know, that very much is something that companies will tell you that they do. If they can't cover the losses on the thing that's being tariffed, they'll find other ways to do it. We actually don't have prominent examples of that yet, but that's certainly a possibility. And that did happen in the last tariff episode with washing machines and dryers.
Thank you, Mr. Chairman. And finally, you know, there's indications in the introduction of the report that the Fed is losing its ability, as we see interest rates getting closer and closer to the minimum threshold, the ability to stimulate this economy in times of recession. We haven't had a recession, or at least we haven't had an extended recession in a decade and a half. I am particularly concerned now as we are looking at debt that is being considered to be imposed on future generations by this particular bill. Could there be a combination of very high debt and very little room to move in monetary policy that could undermine our ability to respond to the next recession?
So we faced that issue quite a bit in the era of very low interest rates, but you know, we're at higher levels of interest rates now, so there's significantly more room to cut than there was then.
Thank you.
Gentleman yields back. Gentleman from Wisconsin, Mr. Fitzgerald, you're recognized for 5 minutes.
Thank you, Chairman. Chairman Powell, thanks for being here today. Appreciate it. I want to go back to something we had some brief discussions about this in the past, but in September of 2024, with core inflation still being above target and the labor market was holding steady at the time, the Fed made a decision to cut rates by a full 0.5 percentage point. It kind of raised some serious questions as to whether or not the data truly supported such a move at that time, and I think some of us were surprised that it was a full 0.5%. So can you revisit that again, what the Fed was thinking at that time? Because it seems to be somewhat of an enigma now. It stands out as, you know, why was this done? Why was the 0.5% done at that point?
I'd be glad to. So first of all, actually the inflation and employment readings were very similar then to what they are now. They weren't terribly different, a tenth or two.
Right.
But the difference then was, you mentioned that the labor market was stable. It wasn't. The unemployment rate had actually gone up almost a full percentage point. I was very clear about this. We were very clear about it in real time too. The concern at that time was that there really hasn't been an experience, or hadn't been an experience in the modern era, in which the unemployment rate has gone up close to 1% that hasn't been followed by much higher levels of unemployment and a recession. So we were looking at that and saying, and remember, at the point we're talking about, the federal funds rate was 5.3%, so definitely a very restrictive level. We were the last of the big central banks to cut. So we wanted to make a statement that we were supportive of the labor market and not just inflation. We've been focusing on inflation. I was quite clear about this. So it was all about the labor market. Inflation was the same and unemployment was roughly the same, but it was the rate of change with the unemployment rate that raised a lot of concerns. And remember, we were being criticized for being late to cut. So we could have done 25. If we'd done 25 in July, we were criticized for not cutting in July. Instead, we cut 50 in September. And it seemed like the right thing to do. You know, and at the end of the day, we do what we think is the right thing when we think it's the right thing to do. We don't take into consideration political factors. If we start doing that, I don't know where that stops. Once you start considering elections and stuff like that, where does it stop? You know, so
And I didn't want to insinuate that it had anything to do with the election itself, but there just seems to be some very similar numbers right now. And I'm wondering, and I don't bring this up because I want to kind of make a point about did the Fed do the right thing or not. I bring it up because it seems like everything's in place right now to kind of do the same thing, make the same move. I know this morning already, you've talked a little bit about where you were on inflation right now and kind of what you're watching, but is there any lesson there? I mean, are we in a position where it would be appropriate to do something as big as a 0.5% cut again?
Well, look, as I said earlier, if you just look at the basic data and don't look at the forecast, you would say that we would have continued cutting. The difference, of course, is at this time, all forecasters are expecting pretty soon that some significant inflation will show up from tariffs. Now, and we can't just ignore that. But we're not. We're just saying let's wait and see more. That's all we're doing. And if you will have noticed, a substantial majority of the committee has written down rate cuts in the remaining 4 meetings this year. So it's just a question of being prudent and careful. But at a time when the labor market is still strong, we don't see weakness in the labor market. If we did, that would change things. We're going to continue to adapt as the data adapt. But that is the difference between then and now. Then, inflation was forecasted to continue to come down. Here, it's forecasted to go up by all forecasters. So, and again, we're not overreacting to that. We're just saying, hey, as long as the economy's strong, we can take a little bit of a pause here. And that's what we're doing. And again, continue to adapt as the data comes in. If we see data that suggests that inflation's not going to produce big increases, that would matter. And if we saw the labor market weakening, that would matter too. But we don't see those things.
What about supply chain? In 2020, that was a big issue, obviously related to COVID. But I know myself and other members, when we're in our districts and we're specifically talking to light manufacturing, there's concerns about the supply chain. Is that part of the data package that you review when you make a decision about where we're headed in the future?
Very much so. I think that's one of the great, well, I won't call it a great thing, but one of the lessons to be taken from the last episode is supply chains really matter. We're watching that carefully. It's too soon to say really on that. We're not seeing it yet, but we could.
Gentleman's time has expired.
Thank you, Chairman. Yield back.
Thank you, Mr. Fitzgerald. The gentleman from New Jersey, Mr. Gottheimer, you're recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, as a member of the Intelligence Committee, I'm deeply concerned about the threat of Iranian cyber attacks on our financial system as retaliation for our strikes on their nuclear facilities. In its cybersecurity report last year, the Fed acknowledged that critical infrastructure, including financial services, is at risk with rising geopolitical tensions. Iran has a history of targeting American infrastructure companies and financial institutions and banks, which could obviously threaten and cause economic damage. What actions is the Fed taking now to monitor and defend against Iranian or proxy cyber threats targeting our country's financial institutions?
So we're in touch with the other regulators and the parts of the government that work on cyber, as you know, and we're in touch with the banks to say, for people to be on the alert for things like that to happen, and also we're on the alert because we're a target as well. So you're right to raise it. It's a big issue, and
you feel like you have the resources right now to be prepared for that?
Yes, I mean I think we do. We spend a lot, and the government generally spends a lot on these things, and but you can never ever be comfortable in this area because the bad guys are always getting better, so we need to keep to get better.
Thank you, Chairman. Switching gears, the President and members of his administration have recently called you out, various name calling for certain decisions you've made. I know that some people worry that the President's bullying will impact your decision making. I know you work together, and I know that and respect, obviously, your independence greatly. Anything you want to add and give you a chance to reiterate your independence to the American people?
Yeah, I would just say we're focused on one thing, and that is we want to deliver a good economy for the benefit of the American people. That's it. And anything else is kind of a distraction. I don't mean to refer to any particular thing, but we stay focused on that task all the time. We always do what we think is the right thing to do. And, we live with the consequences. And I don't know how else to do the job.
Right, so the name calling and the Mr. Too Late and all that stuff, the American people shouldn't worry about that. You're focused on being independent.
Just, yeah, that's what I care about. I care about doing the job for the American people. The things we do matter a lot for people's lives, and that really concentrates the mind. You want to just stay focused on that task. As long as you're sitting in these chairs that we occupy, focus on that task, do what you think is the right thing, and take the consequences.
Thank you, Mr. Chairman. You've previously stated that you view stablecoins as a form of money. Payment stablecoins are already being used for both retail and wholesale payments, as well as for settlement. Recently, this committee passed the Stablecoin Act and the Senate passed the Genius Act, both aiming to establish clear regulatory frameworks for fully reserved dollar-backed payment stablecoins. Given their design to maintain a stable value and be redeemable for U.S. dollars, should the SEC or other regulators explore treating these stablecoins as cash equivalents for accounting or financial reporting purposes?
So let me say, I think it's a great thing that bills are moving. We need a stablecoin framework on that particular issue. I don't have a view for you. I can come back to you on that.
I'd be grateful. Thank you. High rates have also caused, as we've discussed, the cost of paying off our nation's debt to skyrocket. The CBO estimates that interest payments will cost the U.S. $1 trillion in fiscal year 2026 and continue to rise to almost $1.8 trillion by FY 2035. How do you see us continuing to be able to afford to pay off our debt at this rate? And as the U.S. continues to borrow, how does that impact your decision to keep or cut rates? Obviously, foreign countries like Japan, who are significant buyers of our bonds, have started decreasing their purchases significantly. Other internal pressures worldwide are having that impact. Are you worried about this global issue?
Fiscal policy and it really is not our job, and it's not something we take into consideration in making monetary policy. That's really elected people's jobs, and I would add that, for some time now, the U.S. federal fiscal policy has been on an unsustainable path, and, I'll limit myself to that.
Last question. Last week, you chose to keep rates steady, and families in our state, as you'll hear from a lot of people today, are really struggling with the higher cost of borrowing and putting off bigger purchases on things like cars and homes. As a result, their wallets being crushed by these price hikes and obviously the president's tariffs. What do you have to say to Jersey families who are struggling with higher costs, and how you look at how they should forecast themselves for their own families?
We're committed to returning inflation sustainably to 2% and keeping it there in the long run. And what we're doing now is we had cut rates by 100 basis points, so they've come down quite a bit. And when the time is right, I expect that will continue, and that will depend on economic factors, in the coming months for starters.
Thank you. I yield back. Thank you, sir.
Gentleman yields back. Gentleman from Nebraska, the chair of our Housing and Insurance Subcommittee, Mr. Flood, you're recognized 4 or 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, later this week, the banking agencies will be proposing changes to the supplementary leverage ratio, which we think are long overdue, considering the Fed in 2021 indicated that they would soon put out proposals for reform to the SLR and never actually did. However, our understanding is that the proposal being considered this week will not allow for treasuries to be excluded from the SLR calculation. Secretary Bessent earlier this year had argued that such a change could serve as a boost for banks and their ability to intermediate in the Treasury market and could potentially pull Treasury yields down 30 to 70 basis points. Chairman Powell, do you agree with the Treasury Secretary's comments on the potential positive impact of SLR reform on the Treasury market, and what is the rationale for not excluding Treasuries from the SLR calculation in the proposed rule?
So I agree that when the leverage ratio is binding, it discourages banks from undertaking low-margin, fairly safe activities, such as mediation in the Treasury markets. So this should encourage more mediation. I don't have a numerical estimate of how much that would matter, but I do think it would matter. I think it was important. I've supported leverage ratio reform for a very long time, since before 2021.
Chairman,
in terms of the structure of the thing, I think we're seeking comment on a particular proposal that doesn't involve exclusion, but we're also asking a question about exclusion.
Mr. Chairman, considering the Fed temporarily excluded Treasuries from the SLR calculation during the COVID pandemic, were you aware of any safety and soundness or financial stability problems that arose as a result of that decision? And if not, why was that relief terminated in 2021?
So that was an emergency measure. From the beginning and end, it was an emergency measure. I think, you know, my long-held view is that we should have a permanent measure, and now we're going to. And you know, we have an open board meeting on Wednesday afternoon, and after I finish my hearing on the Senate side, and I'm very much looking forward to putting this proposal out for comment.
Thank you. In March, the Federal Reserve, together with the FDIC and the OCC, announced that they intend to issue a notice of proposed rulemaking to repeal the 2023 Community Reinvestment Act and replace it with the legacy CRA framework. Nearly 3 months have passed since this announcement. What is the status of this project?
Well, we're going to do what we said we were going to do. It's just a question of execution, and I think you'll see that coming. This would be so Vice Chair Bowman has the job of sequencing these things, and that one's certainly coming.
Do you intend to issue a proposal that will be a clean rescission and replacement of that rulemaking, or are you considering amendments to the legacy rule?
I honestly don't know. We'll come back to you on that.
Okay, so we should know more later this week?
We might, yeah.
Okay. Finally, I'd like to build off of what Congressman Stile asked previously on the Supervision of Novel Activities program. Do you feel any changes could be made to it to encourage innovation, and do you anticipate any such changes to the program?
I do, and I also think Governor Bowman, now Vice Chair Bowman, is someone who is actually deeply knowledgeable and experienced in supervision, and that hasn't really been the model. We've more had people who are experts on regulation. I think she brings a particular ability to move supervision in a healthy direction while also preserving safety and soundness. And that's what you mentioned is one of the dimensions in which I think that will be true.
Thank you for your testimony today. I appreciate your service to the country. And with that, I yield back, Mr. Chairman.
Thank you.
Gentleman yields back. The chair recognizes the ranking member of our full committee, Mrs. Waters, for 5 minutes.
Thank you very much, Mr. Chairman. Chair Powell, I appreciate that despite the repeated attacks by the President and his cabinet on you personally, that you stood your ground and you did not bow to pressure from Trump, especially given the current state of economic uncertainty due to his policies. Last week, the Fed held interest rates steady. Afterwards, you said that you and other experts continue to expect a meaningful amount of inflation due to Trump's tariffs. You said that it may take some time for the tariffs to work their way through the supply chain, but that you found, and I quote, many companies do expect to put some or all of the effect of tariffs through to the next person in the chain and ultimately to the consumer, quote, end quote. So while the president may try to claim other countries pay these tariffs, can you confirm that it is indeed consumers and businesses in the United States that will bear these costs?
So it can be anybody from the exporter, the importer, the retailer, the manufacturer, or the consumer that winds up paying these tariffs. In the beginning, it will be the importer that pays the tariff, but ultimately it will be spread out among those 5, each of which will try very hard not to contribute, but in the end, the tariff will be paid. And you know, all of the data suggests that at least some of that will fall, not all of it, but at least some of it will fall on consumers.
Well, you indicated it may take some time for tariffs to work their way through the supply chain. Would you elaborate on this, including when is it that we can see negative impacts to inflation from Trump's tariff policy?
So, you know, the things that are being sold at retail now, they might have been put into inventory before the tariffs in February or March. So we think we should start to see this over the summer, you know, in the June numbers and in the July numbers. And if we don't, I think we're learning here. If we see less pass-through, there aren't historical experiences we can consult here, really. So it may turn out that the pass-through is less or more than we think. And I think we're going to be learning. You know, we'll get a number for June. You know, an inflation number for June. We'll learn something then. We'll get it for July. As we go through the summer, we should start seeing this. And if we don't, I think we're perfectly open to the idea that the pass-through will be less than we think. And if so, that'll matter for our policy.
Well, you know, I've been talking with a lot of my constituents about these tariffs. And the question that comes up is, now, is this going to only hurt maybe the big businesses? What about our small business people? What about the people that we buy goods and services from every day in our communities? Is this going to hurt big business as well as small business?
Yes, I mean, I don't think it's, I think it will certainly, if you're a smaller company that maybe imports a single product, that's a common business model these days, then you may if your product is tariffed, you may be the one that's affected significantly, whereas bigger companies have more resources and a more diverse product line.
Why do you think you can resist the president basically telling you what to do? What gives you that authority?
I don't think about it that way at all. I think I have a job that I'm sworn to do, and all I think of is how much people rely on us to get it right. You know, it really matters that we get it right, and that concentrates one's mind, and so that's what we think about at the Fed. We think about what's the right thing. You know, I have, all I want to do in what's left of my time at the Fed is have the economy be strong and have inflation be under control, have a solid labor market. I want to turn it over to my successor in that condition. Of course, that's what keeps me up at night, is to do that. And that's what I think about. That's the only thing I think about.
So how are you protected? By law, by Constitution? Where does your authority come from?
I think, you know, I've covered all that. I do think we're fully protected, and again, I don't think about that anymore. What I think about is let's just do our jobs, and that's what we do. You know, we don't talk about those issues at all, and all we do is do our jobs as best we can. And you know, it's not an easy job, but it's one we've willingly taken on, and very important that we remain focused just on the job and not on other things.
Thank you very much. I yield back.
The gentlewoman yields back. The chair recognizes the gentleman from New York, our vice chair for communications, Mr. Lawler. You're recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, as recently as yesterday, Fed Governor Bowman indicated that if inflation pressures remain contained, the Fed should consider lowering rates, and said she is open to a rate cut in July. Governor Waller said very much the same. Do you believe that we are in a position where we may be able to cut rates in July?
So I would say this. I think if it turns out that inflation pressures do remain contained, then we will get to a place where we cut rates sooner rather than later. But I wouldn't want to point to a particular meeting. I don't think we need to be in any rush because the economy is still strong. The labor market is strong. If we were to see the labor market, you know, meaningfully weaken in a way that was concerning, that would matter for that decision. But if we see inflation, you know, continuing not to move up, we hadn't expected inflation to move up much. We do expect it to move in the summer, and if we see it not happening, you know, we'll learn from that.
The September 2018 Teal book suggested that the Fed, seeing through tariffs' inflationary effects, is an appropriate response so long as inflation expectations are firmly anchored and that the pass-through costs are relatively short-lived. Would you agree that this assessment from the Teal book still applies to today?
I would. Those are the exact factors that we cite when we talk about this situation, plus the size of the tariffs.
Right. So let's assess the current economic situation. The Monetary Policy Report states that longer-run inflation expectations, quote, continue to be broadly consistent with 2% inflation, unquote. And a Harvard study argued that despite the relatively quick price responses to tariff announcements, the overall magnitude of these changes remains modest. So if these conditions hold, is it not unreasonable to think that underlying inflation trends should continue its path towards 2%?
That's certainly a very defensible position. I think what others on the committee think, and what I think, is that this is a question we need to be careful with because it's different than it was in 2018. The difference is that we haven't had 2% inflation. In 2018, we hadn't had an inflation as high as 2% for a decade anymore.
Right.
This is a different situation. We haven't fully restored price stability, and another shock we have to be careful. If there's a meaningfully large and sustained inflation shock, we have to be careful about that. And so, I think we're just trying to be careful and cautious, and we really think that's the best thing we can do for the people that we serve. If that happens, we need to be there for it. And so, we're in a difficult situation in deciding exactly when to move. But again, if we continue to see inflation come in, and not prove up at the higher levels than we expect, then that would matter for our decision making.
Chairman Powell, economist John Taylor once noted that the Federal Reserve should deviate from its own Taylor rule in the event of an oil shock. Similar to the tariff scenario, a one-time price increase from an oil shock should not be accompanied with an increase in interest rates. Do you agree with that assessment?
I generally do, yes.
Previously, you said that if you wait for inflation to get back down to 2% to cut rates, you are already too late. You also said in November 2024 that inflation was on a sustainable path to 2%. Given that the FOMC believes that interest rates now are moderately restrictive and that an oil or tariff shock may not impact underlying inflation in a significant or meaningful way, because as the Monetary Policy Report established, inflation expectations are firmly anchored, what is the reason not to cut rates?
Well, it's uncertainty about the size and potential persistence of the potential but highly uncertain inflation from tariffs. By the way, we have 5 Taylor rules in the Monetary Policy Report. 4 of them say that the policy rate is in the right range, and the other one calls for a hike.
Right.
Just for the record.
Well, back in the beginning of the Biden administration, okay, when we talk about inflation, they increased federal spending by $2.5 trillion each year. $5 trillion in new spending. That's what gave us inflation, by printing all of this new money and borrowing, and yet you did not respond to that by raising rates. In fact, you were late to raise rates. And now, again, we see a situation where you are late to cut rates. That is the challenge here.
Gentleman yields back. Chair recognizes the gentleman from Georgia, Mr. Scott, for 5 minutes.
Thank you, Chairman. Chairman Powell, to the best of your knowledge, has President Trump put forward a coherent tariff policy? Is that your opinion?
That is not a judgment for me to make or to discuss.
Well, what do you think?
Sir, it would be inappropriate for me.
You're
I
running
don't comment on the
economy.
president's words or the president's
Does
policies.
the president, in your opinion, does he have a coherent tariff policy? You ought to have an opinion on that. You run our economy. This is your bailiwick. Do you think he's got a good policy? Answer me.
I would never comment on the president of the United States in that way.
All right. What do you think our policy should be?
We play no role in either establishing or commenting on tariff policy or fiscal policy, for that matter. It's not our business. We have a specific mandate. We try to stick to it.
Let me tell you something, Chairman. In my state of Georgia, I got the fastest growing trade group down there. The Port of Savannah is indeed our nation's fastest growing party, and it's rising even more. The cost, the expenses, our business community is suffering. And I want to know what you think of our tariff policy. What do I tell my people? What do we tell the American people? And you're a good man. I want to know the answer to this question. I want to know how you feel. This whole tariff question, it's a tax increase. It's running people out of business. What do you think about that? Give me some sort of answer. Do you think anything about our tariff policy? Don't you feel you have a responsibility here? Are you afraid of President Donald Trump? Why don't you deal with this? Because our economy are suffering in a mighty bad way. And I've got to represent my constituency. And they are, let's take Georgia's agricultural sector, mostly pecans and poultry and cotton exports. They've been hit hard by retaliatory tariffs from key trading partners like China. Why are you running away from the tariff fight? Give us some understanding of that.
Honestly, this is just not our role. We are not a an institution that comments on or analyzes the decisions that the president makes, or the things that he runs for office on and is elected on and then does. We don't. That's just completely out of our lane. It's really inappropriate for me to have any comment on that. I'm sorry to say, Mr. Scott.
We're having these regional disruptions. Our economy is in a bad way. And I want to see you and the president, you got to get together on this. We got pecans in Georgia. We got peanuts. We run the biggest group. We got the fastest growing trade mechanism in the Savannah Port Authority. We're crushed in Georgia. My business folks are coming to me on it. I got to get some answers from you. What do I tell them that the Fed chairman feels about their experience in this tariff? I think we need to get you and the president together.
Gentleman's time has expired. Appreciate the gentleman from Georgia. The gentlewoman from Florida, Ms. Salazar, is recognized for 5 minutes.
Hi, thank you very much for being here. Appreciate your time. And my name is Maria Salazar. I represent the city of Miami, which is one of the cities most composed of Hispanic Americans and people that adore living the American dream. So putting that into context, I wanted to ask you a few questions about the labor force. We agree with what the President Trump is doing, or what the administration is doing in deporting illegals, criminal illegals. We do not want Trenderagua. We don't really want people who have committed any type of crime, even more if they are illegals. And but we do know that unfortunately what's happening right now after 6 months of being Mr. President being in office, that we're losing thousands and thousands of workers, what the ICE leadership has called collateral damage. And most of those people are working in three main sectors: construction, hospitality, and agricultural. Even the president said the other day in a tweet that he understands that those hands are needed. We're talking about 15% of the economy: construction, hospitality, and agricultural. So my question to you is, what is the growth effect on the economy if this type of removal of people, of hands being removed from those three main top sectors?
So immigration is another area where nobody put us in charge. We're not, Congressional Budget Office and other agencies can make assessments like that. We do have a role to maximize employment, but we take immigration policy as we take it as it comes. What it's obviously done is it's really reduced the amount of growth in the labor force. And so at the same time, demand for workers has been coming down as well. Because they've been coming down at about the
one
same.
drop at a time. Reduce the growth. Why don't we talk a little bit more? Because we want to continue growing. We're the #1 economy in the world. We need to continue growing. So you're saying that what's affecting the growth?
Well, there are two things that impact growth. One is growth in the labor force, more people working, and the other thing is productivity. How much do they produce per hour worked? And when you significantly slow the growth of the labor force, you will slow the growth of the economy. But I think, again, it's not for us to have a view on immigration policy.
No, I
can just
understand. It
report
was
that.
just my comments, but you do agree that if we don't have those hands, then we don't grow.
I think that growth will slow, and actually is slowing this year, and that's one of the reasons.
Well, we don't like that. So now let's talk about of the next 10 years, 2025 to 2035. Americans are not having enough kids, so that means that we need other people, right? So over the next decade, based on the current trends that I just explained to you and that you just reiterated, will there be enough workers to fulfill the labor needs of our economy between 2025 and 2035?
So I think labor economists do observe the phenomenon you're talking about, which is demand for labor going to be met by the domestic population, the native-born population, and the answer appears to be probably not over the next 10 years.
And then what about if we do not have that labor force over the next 10 years? What happens?
So many things will happen. You can see a big increase in productivity, which would mean we don't need as many workers. For example, artificial intelligence could be implemented in a way that creates widespread productivity gains. I wouldn't count on that, but it's a possibility.
You would not? You would not count on that?
I wouldn't count on it.
You would not?
No, I mean, I think
Why
there'll
not?
be gains because with productivity enhancing things, they typically take longer to be implemented, and then it takes a while for the gains to be shown. I think in the case of artificial intelligence, those gains are coming, but they may take longer or be less in the beginning than expected.
And during the time that those changes happen, then what happens? Our economy doesn't grow. Is that what you're saying?
Yes, but I mean, those who make immigration policy are entitled to weigh these factors. We
I
can
hear you.
report on what happens, but it's
know that.
really not our job.
I understand it's not. I just want to hear what you're thinking, what's your expertise based on those immigration laws that we're implementing right now. The last one, because I only have 30 seconds. Do you think that with everything that we have talked about, do you think that we can continue remaining, or the United States economy can continue being the #1 economy in the world, and that we could compete if we were to have the immigration laws that we have right now?
I think you could have, the highest per capita earnings, but if you're talking about the aggregate output, then, population growth may be a constraint.
Now, which one of the two is more important?
Gentleman's time has expired.
Good question.
Well, you can, I think he...
Gentlewoman's time has expired.
All right.
Let me turn
Thank
to
you,
the
Chairman.
ranking member of the House Intelligence Committee, Mr. Himes, for 5 minutes.
Thank you, Mr. Chairman, and welcome, Chairman Powell. Let me start by thanking you for your careful keeping in your lane and steering clear of fiscal policy, and in particular for your stalwart defense of independent monetary policy. You're getting pressure from very powerful places and lots of kibitzing from lots of members on the interest rate question, and most know better that our independent monetary policy is the very bedrock of our economy. So thank you for that. Mr. Chairman, I want to talk just a little bit about some of the technical matters associated with energy prices and inflation, because obviously turmoil in the Middle East has sent oil prices swinging wildly, with West Texas Intermediate in the last month or so being anywhere between $61 and $75 a barrel. We recently saw the Iranian parliament vote to close the Strait of Hormuz, which currently handles around 20 million barrels a day, a fifth of global demand and a little bit more in terms of natural gas. Chair Powell, you said last week that conflict in the Middle East in the 1970s resulted in very large inflation shocks. In contrast to the 1970s, today the United States does not import most of its energy. We call ourselves energy self-sufficient on a net basis. But I hear the argument made that I think is wrong, that because we're energy self-sufficient, somehow we are insulated from global energy market prices. Can you comment on that? Is there any validity to the notion that we are not, American consumers of energy are not subject to global swings in energy prices?
Yeah, so the price of oil is set globally, right? And I think if you go back a few years, the thought was that when the global, we had a natural shock absorber, which is that we would just drill more. And that we would, if prices went up, we would drill more. And so you wouldn't have these sustained price shocks that we had during the 1970s and the original OPEC era. I think that is actually in question now because, the oil industry in the U.S. is being much more careful and focused on return on investment than they were, having been burned with overcapacity.
Right, and I mean, yeah, in the long run, you can invest in additional extraction technologies, but this does not respond to day-to-day spot prices. So
not quickly,
the point
no.
I'm trying to make is that the conflict in the Middle East, if it resulted in $120 barrel oil, which is where oil was in 2022, that would have a fairly substantial inflationary impact on the American household. Is that correct?
We would certainly feel that, and as we've discussed earlier, there's a lot of lore around looking through oil price shocks, but that depends on the facts and circumstances.
What, as a technical matter, we tend to refer to CPI, which is a basket of goods, and we measure the price changes. Roughly speaking, what percentage of that basket is comprised of energy?
I don't have that on the top of my head. It's much less than it was, of course. And oil consumption is much less than it was in the 70s as a percent of GDP.
But energy includes natural gas and gasoline, and it's a meaningful portion of the
yes. Although of course we have more natural gas than we have so much natural gas, so that'll always be there for us.
So none of us can predict what's going to happen in the Middle East in an hour, much less in a week or a month or a year. But as a technical matter, at what price for a barrel of oil does the American household begin to feel inflationary effects? So we're at $75 a barrel roughly right now. At what price point does the American household begin to feel some inflationary effects?
I don't want to throw out a number. I think we're frankly, it's too early to say that something like that's going to happen, and I know you know that, but I wouldn't want to throw out a specific number. If prices went up materially, people would feel that.
Okay. Again, I think if I look at the data here, WTI per barrel, about $120, it peaked at about $120 in 2022. What do your models suggest would occur to inflation, and how would it influence the Fed's thinking should we be back at $120 a barrel?
Well, let's just say there's a big price spike in that range. So, we would look at that and we would ask ourselves, we look at the overall situation, we would ask ourselves, should we react to that? So, for example, during what we called the Arab Spring back in the early teens, oil prices went up a lot, and that went into the price, and there was a discussion, and I think the right answer was to look through that. The question you'd be asking to yourself, because by the time you react, the price comes back down. I think the question today would be, is the situation different, and what would be the implications of those differences?
Gentleman's time has expired. I thank the gentleman from Connecticut. Chair recognizes the gentleman from North Carolina. Mr. Moore, you're recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, I want to touch on international standard-setting bodies like the Basel Committee on Banking Supervision. Their goal is to promote better harmonization for global capital flows and regulatory standards, but the Biden administration's implementation of Basel III endgame demonstrated the pitfalls when the U.S. is a follower instead of a leader in the international arena. That's why both Democrats and Republicans shot down former Vice Chair Michael Barr's proposal, which made capital less acceptable and put U.S. firms and businesses at a global disadvantage. Do you agree that the United States should only implement international standards in a way that is consistent with our own domestic legal and regulatory scheme?
I do.
I appreciate the Federal Reserve's announcement yesterday to end the use of reputational risk during banking examinations. This supervisory practice was used as a tool to pressure banks to refrain from offering financial services to politically disfavored individuals or industries. What further steps is the Federal Reserve taking to help usher in these changes, such as ending examination practices that informally encourage banks to close certain accounts without written justification?
So we're developing, I should say Vice Chair Bowman is developing a range of policies that will help in that area, and I should let her speak to it. But as you know, we've eliminated reputation risk largely in a thoughtful way from those things. I think we became more aware of that problem over the course of last year, and like the other agencies, decided to move away from that. We're very conscious of the fact that we shouldn't be telling banks who they can lend to, that that's a decision for them in the private sector.
Let me ask you this, how are you ensuring, though, that like the frontline examiners are aligned with this new direction and not continuing with any past practices?
You know, I will say that is the ultimate question, is will and I think they will, and I think as a former bank examiner, Vice Chair Bowman is actually very well positioned to engage with supervisors and in a way that someone with experience can do successfully, whereas if you don't have that experience, I think it might be harder.
Thank you. You know, Secretary Bessent recently announced a drive to change the culture of supervision through improvements to examination procedures, enhanced monitoring of examiners' compliance with those procedures, and more realistic processes for appealing supervisory findings. That includes defining unsafe and unsound by rule using more objective measures rooted in financial risk. Do you support this initiative, and will we be seeing further rule changes at the Federal Reserve to achieve this goal?
So I like the sound of all that. I will say on issues of supervision, Vice Chair Bowman has significant authority, and also she's got the background and the understanding, and the first thing I would do is I would ask her what she thinks about that.
Okay. Just sort of a changing direction on a couple of questions. During the volatility in the Treasury markets last April, some have speculated that foreign investors were dumping Treasury securities. Since then, though, recent data has showed that foreign investors' holding of U.S. Treasuries held close to a record high in April. Does this data show that Treasury's safe haven status and the dollar's global reserve currency status remained strong while the administration conducted trade negotiations?
I would say yes to that. I think we need to be careful about these narratives that pop up quickly. I mean, we're the world's reserve currency and the world's greatest democracy, and I think the dollar is always going to be, for a long time, is going to be the reserve currency and the place where people want to be.
Let me ask you this. Do you believe there's a possibility that Treasury markets will crack, just as Jamie Dimon has recently warned at the Reagan National Economic Forum?
I don't want to say things like that. I don't think that's something that's happening. Treasury markets are functioning well and normally, and they did function through a period of pretty substantial stress. And as you pointed out, Mr. Moore, that they're focusing well now.
Thank you. With that, I yield back. And actually, if Ms. Salazar is still here, I'll give her my remaining time. If not, I yield back, Mr. Chair.
Gentleman yields back. The chair recognizes Ms. Williams of Georgia. You're recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Chairman Powell, for being here. It's been a while since I've had the opportunity to ask questions sitting at the bottom of the room, but I am happy to have this conversation today because the last time we talked, last July, I mentioned that combating economic inequality is a critical part of the Fed's dual mandate, and that is something that I am deeply, deeply interested in. Back then, we were talking about how we can get everyone in our economy to have the opportunity to contribute to their fullest potential, because that's how we get our economy firing on all cylinders and work to continue to close the racial wealth gap, which my home city of Atlanta continues to lead the nation in. That seems like such a far cry from where we are today, almost a year later. Forget our economy firing on all cylinders. Now our economy and our nation seem to just be on fire. We're looking at tariffs that are raising the prices of groceries, fuel, housing, and everyday goods. Chairman Powell, I get feedback every time I'm in a hearing about my nails because I like to get my nails done. And my nail tech told me about the increase in cost of so many of the different products that would be used just for me to get my manicure monthly, because tariffs are frightening so many of our small businesses, which we know are the backbone of our economy, and so it's hurting my community in Atlanta. But it doesn't seem like our president and my Republican colleagues are really interested in making sure that our economy fires on all cylinders, as long as billionaires continue to get richer, because that's what we've seen and all of the gutting that has been done to the federal government. And Chairman Powell, I'm sure that this is coming to your department as well. With the recent events that we've seen, we know that it is very dangerous to gut the federal government, agencies that we depend on, and politicizing the work of agencies such as yours. Chairman Powell, this current president has tried to reclassify tens of thousands of non-political public servants just to make it easier to fire them. And that includes people who have served in Democratic and Republican administrations. It even includes people who serve in independent agencies just like yours. Chair Powell, as a chair who our current and previous president routinely has threatened to fire, I think I just heard something on CNN today while you were here testifying. But what effect has this policy had on the career civil servants in your agency? And are these threats making it easier or harder for the Fed to do monetary policy?
They're having no effect. We're doing our jobs.
You're doing your jobs. I appreciate you doing your job, even when it might not be easy. It is important to tune out the things that you hear on the media, because I hear it every day representing a district that has a lot of federal employees, a lot of people who work at your agency. I hear from people all the time. Thank you so much. And not only do I have thousands of federal employees in my district, but my district has one of the widest racial wealth gaps in the country. Much of that has to do with our worsening housing crisis. And unfortunately, as we've seen with the past 6 months, this administration has been focused on this big billionaire bailout bill, gutting HUD, and releasing a budget that does not help the supply of fair and affordable housing nationwide. Now we've heard the president talk about having the power to control interest rates. In your opinion, Chairman Powell, what would you expect the effects would be on the housing market if the president were to lower interest rates without addressing the housing supply crisis nationwide?
Sorry, if he were to what?
If the president has talked about having the power to control interest rates. In your opinion, what would you expect the effects would be on the housing market if the president were to lower interest rates without addressing the housing supply crisis nationwide?
Honestly, it's not our job to speculate on things the president might do.
So what impact do interest rates have on housing access?
Over the long run, they don't really affect housing supply. You know, assuming that rates will go up and down.
Well, not on the supply, but on the housing market. The supply is separate that we need to address going into this. If we're going to move interest rates up and down, that's not going to be the end-all, be-all to getting people into housing. We must address the housing supply crisis. But what impact do interest rates have on the housing market in general?
Well, interest rates really affect housing demand. So with lower rates, you see more demand, and higher rates, maybe less demand.
Thank you, Chairman Powell. I am out of time, but I have lots of questions that continue to work to close the racial wealth gap in this country, specifically focused on my district in Atlanta, where it is so prevalent. Thank you so much.
Gentlewoman's time has expired. The gentleman from Indiana, Mr. Stutzman, is recognized for 5 minutes.
Thank you, Mr. Chairman. And Chairman Powell, great to see you. And again, as I've mentioned to you before, always appreciate your steady hand at the wheel and not, I guess, getting out of your lane necessarily, but obviously you have a huge impact on the economy and what's happening there at the Fed. I want to kind of follow up a little bit on housing, as I've been hearing a lot about the housing concerns in Northeast Indiana, and I know you're not you're used to being beat up on a lot by folks all around the country, but I want to speak specifically to one particular individual, Grant Cardone. He made some pretty strong remarks about your policy when it comes to the housing industry, and he said, that's why you have 500,000 more homes listed than buyers for those homes. When the rates come down, prices will also come down with it, because you'll have more supply in the marketplace, and supply is what controls prices. He went on to say that interest rates do not control prices, and he explained that lower rates could stimulate activity in the market, and activity is what makes the economy work. And I agree with his comments, overall, but I believe, as you said earlier, the economy seems stable, and I would agree with that coming from an ag and manufacturing area. It's not booming yet, but I believe most people are optimistic that the good times are coming and that the structure is set and in place. But when it comes to housing, it seems like that's where a lot of Americans are, they're stuck. You know, they've had low rates, they've got a good mortgage rate, but if they want to make a move, they have to go out of that 3% interest rate into, 4.5%, 5% or higher percent interest rate. Thoughts on addressing housing, because their prices are up for sure, but people aren't, there's no activity. There's the velocity is very slow. Would you like to comment on any of that?
Sure. So yeah, we see the same thing you do in the housing market. It's tough. There's not people are locked in. They can't afford to get out of their house because the cost of getting to a higher mortgage, higher price mortgage would be a lot. So the best thing we can do, though, is to get inflation sustainably down to 2% and have it stay there over a long period of time. A long period of time, and that is really what we can offer to them. And I think, so if you go back to the beginning of the pandemic, when we cut to zero and we did all those programs, we really saved the housing industry because they're the front line for interest rates. At a time like this, when rates are, I would say modestly restrictive, not even moderately, but modestly restrictive, they feel it, and their customers feel it. We understand that, but we only have one tool for the whole economy, not just for housing. So it's something we consider, but we have to consider the bigger picture. And I do think in the medium term, as rates come down, you'll see normalization in housing. Of course, there'll still be a national housing shortage. I don't know about your district, but
yeah, no, there's a shortage.
Yeah.
I mean, considering the macroeconomics of interest rates, I mean, how much consideration do you take housing into that decision as you address interest rates?
We're always briefed on it. We always talk about it. We always look at it. But at the end of the day, it's the big U.S. economy, the whole aggregate thing that matters. We also talk about the agricultural economy a lot as well. But ultimately, and manufacturing, it's got to be the whole, and not any one particular piece.
Yeah, I just would mention it is hard for American families to make that move, and they're stuck. And so I would just highly consider, ask you to consider that piece of it, because when Americans can't move and Americans can't upgrade or move laterally even, it really keeps the economy kind of holds the economy back a bit when Americans don't have that. But again, I want to say thank you, because you have a tough job, but I haven't heard from anyone in my district asking interest rates to go up. So I'll just pass that along from Indiana's 3rd District. So with that, Mr. Chairman, I'll yield back.
Gentleman yields back. The chair now recognizes gentleman from Colorado. Ms. Peterson is now recognized for 5 minutes.
Thank you, Mr. Chairman, and great to see you, Chair Powell. Thank you so much for being here today. I want to thank you for your long service to our country. I know that you've served under many Democrats, Republicans. You've always been nonpartisan and done your job to put our country first, and we appreciate your steadfast leadership. And if you are not reappointed, it will be very missed here. I have some concerns when I think about, I know you've touched on this a little bit through the questions today, but around the independence of the Federal Reserve. Your job, no matter what president you served under, Republican or Democrat, was to make sure that this was not a political position, while you brought news that some would not be happy about because it reflected what you had to do to address inflation. When I think about the conversations we've had going through the global pandemic and the economic fallout, and how we had to infuse money throughout our country to keep our services afloat, our businesses afloat. And while we suffered from inflation like the rest of the world, we had the quickest, strongest recovery. We were leading the globe, and so much of that was because of your leadership. And so when I think about what this position means, how important it is that there is independence, what are your biggest concerns about a potential successor that doesn't prioritize that and wants to do what is politically asked of them versus what they need to do for the country, and what are their long-term repercussions if you're not acting on addressing the economic uncertainties and trying to address inflation in this position?
So I wouldn't speculate on that, but I would say, the credibility on the Fed on price stability is very, very important. People believe that we will bring inflation back down to 2% over time. And once if they really do believe it and it's true, then that'll have big effects on not just short-term rates but long-term rates. If that were to be called into question, then you'd see long-term rates go up. I mean, that credibility once lost is very expensive to regain, is what the historical record says. So I just think I think people should understand that credibility on inflation is hard won and something we need to constantly tend. And that's what we're doing with our current policy, is just being careful with potential inflation risks. We haven't overreacted. In fact, we haven't reacted at all. But we're being a little bit careful about that set of questions as we decide what to do next.
And thank you for bringing that up. As we look at where we were, how far we had come in our economy, things were starting to stabilize, and we were starting to finally see a relief on the interest rates. They were starting to go down. Now they're holding steady. Can you talk about why the instability? When we look at tariffs around the increase in the deficit by the proposed big ugly bill that is being brought through Congress right now, and increasing our debt by trillions of dollars, and having our credit downgraded again because we are increasing our deficit. So with this economic uncertainty, where we were going, we were on the way down for reducing our rates, and now we have to hold steady to address the instability. Is that correct?
I'm sorry, could you just briefly restate your question there? I apologize.
Yes, I'm going to do this the best I can with with Sam here. That with our having to address inflation, as we've started to see it, you were able to decrease the rates. We were starting to go down a little bit. We were seeing that our economy was finally in a solid place. Prices were starting to go down. And now, with the economic uncertainty, we're starting to see that you had to hold steady, whereas everyone was projecting before this administration came in with these changes that it was going to continue to go down. Can you talk about why you have had to choose to hold steady on the interest rates?
So we just, we stick to what we're assigned to do, which is maximum employment and price stability. We don't have opinions on fiscal policy or trade policy or immigration policy or any one of another, or regulation policy, other than that we have our regulatory responsibilities. And so we take what comes as it comes. And, elected politicians do what they do, and we don't criticize that. We don't have opinions about it.
Gentleman's time has expired, and the gentleladies.
Thank you, and thank you, Sam.
Chair now recognizes the gentlewoman from Texas, Mrs. De La Cruz, for 5 minutes.
Thank you so much, and thank you, Chair Powell, for being here with us today. I am Congresswoman Monica De La Cruz, and I am from deep South Texas, a largely Hispanic district, a rural community right there on the border of Texas and Mexico. I serve as the Vice Chair for Housing and Insurance Subcommittee, and it's difficult for families right now to afford a home on an average paycheck. I'm committed to finding affordable housing solutions for the people in my community, but also for all over the nation. So, Chair Powell, mortgage rates remain significantly elevated relative to Treasury yields, with spreads well above historical norms. To what extent does the Federal Reserve believe its balance sheet policy, particularly the runoff of MBS holdings, is contributing to this widening, and how does that factor into your broader assessment of financial conditions?
I don't think that our runoff of MBS is a particularly large contributor to that situation. I also think it's not just interest rates, it's so many things around housing now. It's insurance, it's materials, it's land acquisition, it's labor. There's so many cost pressures that are pushing up housing costs.
Thank you. With that being said, moving on to an entirely different topic, if the Federal Reserve focuses on issues outside its dual mandate, there are more opportunities for policy mistakes. How can you ensure that no other climate policy work is being done at the Federal Reserve?
So it is a big risk to our independence if we were to stray into areas where we shouldn't, that really aren't part of our mandate. And I would agree that climate is the biggest risk. So we really did the bare minimum. We did much less than I think people understand in the climate area. All we did was one piece of guidance, and then we ran one stress scenario, and by the way, didn't find anything. And I think you don't look to us to try to take on a bigger role or really to play any role in climate, which I personally think is an important issue and one that needs to be dealt with by elected officials. And for bank regulators just to step in and take that on without a mandate from Congress is not a good idea. It's not a good solution, and it's not a good way to remain independent.
Reclaiming my time, what kind of climate guidance did you make?
So for just the big banks, I believe, we asked them to monitor to have a framework for which they would monitor their risks from lending. That's all it was. And I would say that that guidance is something we're looking at pulling back.
When you say they're risks for lending based on political climate change, is that correct?
Well, the idea was that the changing climate could, I'm not defending this, I'm telling you what the idea was. The idea was, climate change would cause certain kinds of assets to lose value, and that if banks are lending to in those areas or to those industries, then they should at least be able to measure. It didn't ban anybody from doing anything, it wasn't prescriptive. At the same time, you have the feeling that the side effect of it would be to discourage lending, and we don't want that to be the case, so that's why we're looking at it.
Well, it does sound like that is policy that is based on political agenda. And when it comes to banking, it should not be based on political agenda, but instead on facts. Facts such as credit, facts as good monetary policy. So I would have to disagree with you on the fact that the Federal Reserve stayed outside of political agendas. When it comes to climate change, that is a political agenda, and I would have to disagree with you on that. Thank you. I yield back.
Gentlelady yields back. The chair now recognizes the gentleman from California, Mr. Sherman, who's also a ranking member of the Capital Markets Subcommittee, for 5 minutes.
We don't notice good bank regulation. Things just go smoothly. But in 2023, we saw the effects of inadequate bank regulation, where we lost 3 banks. There was a proposal that passed the House that would have cut the pay rate of your bank inspectors and regulators down to 70% of the rate paid at FDIC. So you would have been 70% of what the other major bank regulation agency did. I know you've announced things about headcount, but I'm focusing here on just the rate of pay. Fortunately, we were saved by not Superman, but Superwoman, Elizabeth McDonough, the Senate parliamentarian. But what effect would it have had on our ability to have good bank regulation if you had to go to all the folks in doing bank regulation at the Fed and say that their pay is going to be cut to 70% of the rate of pay over at the FDIC?
Would have made it harder for us to attract or to retain personnel. It also would have knocked down something we've had for 90 years, which is a sort of a moat that allows us to take care of HR issues on our own without Congress.
Gotcha. I've got a couple of questions I'd ask you to respond for in the record. The first is Section 899 of the big ugly bill, big beautiful bill, whatever you want to call it, enforcement of remedies against unfair foreign taxes. What this does is it imposes a tax on those residents of about 24 foreign countries should they invest in the United States, including in our treasuries. And we're trying to attract capital from abroad. This is to push out capital abroad. It doesn't affect China. It just affects 24 of our friends, particularly in Europe. The other thing I'd like you to respond for is the record is the tariffs and the effect that that has not only on the inflation rate, but therefore on interest rates. And at your press conference, you said increases in tariffs this year are likely to push up prices and weigh on economic activity, and I'd certainly like to know more about that. The Treasury has our reserves, but you also have a liquidity fund, which I believe involves buying and selling foreign currencies. And so that begs the question whether if you're allowed to buy the euro, whether you're allowed to buy cryptocurrencies. And of course, the president has said that some agency of the federal government should have a strategic crypto reserve. Do you or your successors have the legal right to take assets of the Fed and buy Bitcoin or Trump coin?
No, we don't, and we do not seek this authority.
I hope very much that your successor is not someone who tries to stretch existing statutes and come to an opposite answer. I'd like to focus a little bit on when you came before our committee last, I guess, in February. I asked you if you would take a holistic look at bank capital requirements, including the risk-based capital ratios like Basel III Endgame and stress testing, to make sure that you don't have a contraction in the ability to provide credit to Main Street businesses, and you said you would do that. So my question this time is, how does the Fed plan to sequence the various capital requirement reform proposals that we expect to see in the coming months? In what order will you proceed with reforms on Basel III weight risk capital, leverage ratio, stress testing, and the GSIB service charge, knowing that these have interactive effects? Can you tell us what the sequence will be?
So I really do. This is the heart of what the Vice Chair for Supervision is assigned to do, is to bring proposals to the board, and I read that as giving her she's the one who will decide that sequence.
All right, guys, I'm done watching it. Sorry, that was really loud for the stream. I wanted to shut that down. That meeting, I think, goes for like 4 hours. We watched 2 hours of it. I think the good stuff is pretty much done. We're about to get a position right now, potentially, if it gives it to us. That was terrible price action for the last 3 hours of us sitting here looking at the charts. But finally, we might get a position here. And yesterday, we waited really patiently. We waited for our position. Once we got it, it moved pretty nicely and pretty aggressively to our TPs and further. And so hopefully we can get this position here soon. Get a nice little position. Maybe it'll run lower. I don't know. The market's pretty clear on its sentiment right now and pretty bullish. If you look at the 1 hour, it's very bullish, but we could catch a little bit of a retracement for the 1 hour to come down into discount. So I'm not stuck to any bias of bullish or bearish, but yeah, it looks like we're gonna get an opportunity here. Okay. Limit sell. I'm gonna do 5 on this one. I'm gonna do probably do 5. Stop loss is up at the high. Zachary, my stop loss on this, if it hits, I'm gonna put stop loss at 11:45 wick. Yeah. Yeah. There's no other spot to put it. Oh, nice. Maybe. I mean, think of what happened yesterday. It consolidated for like literally 35 minutes or 40 minutes before it finally inverted the candle. Yeah, we'll see. Let's do it this one. I'll delete this for now. No, I can't hear. Yeah, dude, I'm like a little chilly this morning too in my garage. Is it? It's a little cold today. It's not like super cold, but honestly, I'm kind of hoping it's a little cool, like not a super hot day, you know? It's like 6 hours probably, my guess. At least. Yeah, that's a long freaking golf round. Breton. Yeah, I'll bring my Gatorade. I'll be hydrated. I'm gonna bring like I'll probably get like sodas or something. I like Celsius. Oh, they have stuff. Oh, okay. Give it to daddy, come on. Nas daddy wants to give it to daddy. Come on. Oh my gosh. Dude, if this one does it, the move is tiny. I guess it's fine, but kind of sucks. I think I'll do 10. I'm gonna do 10 this morning on this one. I'll do a normal position size. Market's kind of back to normal. How much do I risk on that? Oh, 10 is not bad. I'm only risking 500 bucks. Yeah, I'll do 10. How much are you? You're doing 15? 15? How much are you risking? Or how much does it say you're risking? Oh, never mind. Mine's at the wrong. I'm at a wrong price. If I put it lower, it's gonna be like $1,000 bucks. Or like say if I did there, 700 bucks. Okay, yeah, still it's fine for me. It definitely can in this candle still. I bet you it doesn't actually, but it could. It could. Technically. Yeah, like have our stops a little tighter so it's not risking so much. Yeah. I know, I'm kind of bummed it didn't make a fair value up above us, so then either way the market moves, we get an entry. Oh, that sucked. Leanne, I know you followed 2 hours ago, but thank you so much. I was muted because we were watching the Powell thing, but thank you so much for the follow. Oh yeah, I don't think this one's inverting. Yeah, oh, you think? Oh. Doctor, what are you listening to? Oh, it's only 12 mil? Oh. Only 12 million, that's not that much, right? 1,000. Not just kidding, it's probably like 7,000 square feet. What? Crazy. That's almost $1 million every 100 yeah, every 100 square foot. That's crazy. Okay, sorry Brandon, this one was pretty lame today. Yep, part of it. Have a good day, dude. See you tomorrow. Bye. Yeah, this is these last 2 days have been lame. Congrats on yesterday's trade. Man, I was at the gym, but I watched the replay. Let's go. Thank you, Slayer. Yeah, it's a good little scalp. Good little scalp. I'm kind of bummed I didn't take the second one. I wanted to just be one and done for the day. I should have taken the second one. The second one would have hit too, and we would have had double wins yesterday. But hey, well, you know, profit's profit. We still ended the day green. That's all that matters, right? So yeah, yesterday's trade was great, and it was the same kind of market, like super consolidating, just super slow. And then all of a sudden it decided like, all right, we're moving now. It took 3 hours, but or actually yesterday almost took 4 hours before we got a trade, because we were there at 6. The trade like opened and closed by like 9:40 a.m. and then closed around like 9:55 a.m. I think. So it's like 4 hours we waited and then finally got a trade. So we should get a trade soon. Hopefully we invert this. I mean, the way it just reacted to this fair value gap, it could actually you know, keep continuing on this bullish trend. But I don't think so. I think with this momentum, I think it might have a little bit of a correction, especially after, if you look at the 1 hour, right? The 1 hour, the 1 hour is kind of due for, after this pump, due for a little bit of a, watch out, where is it? Discount. You look at this move, right? Price could come down and retrace back into discount. There's a big 1 hour fair value gap here that never got touched. So I could see price, you know, before we really continue ripping up, have a little bit of a retracement, come down to maybe this fair value gap, or one of these footprints here, and then continuing on. So, but I don't think we're going to go lower. I think if maybe anything, we actually pump and could just rip up to all-time highs. Yeah, or nothing. But thank you, Slayer. Hope you had a good gym session. Yesterday was me and my wife's anniversary, and we actually had a little celebration day. Let's see Bitcoin. There were some good things being talked about in the meeting today in regards to digital assets and cryptocurrencies. So Bitcoin, I'm liking what Bitcoin's doing. So if you look at the weekly time frame, we have this weekly fair value gap right below us. Okay, price tapped into that, is bouncing off. You look at the 3-day, right? 3-day came down again to this fair value gap, had a big reaction off of it. And then if you look at the 1-day, price came into that fair value gap, boom, big reaction off of it, change in state of delivery on the 1-day. You go to the 4-hour, you see inversion of some fair value gaps, change in state of delivery. I don't think this is a break in structure on this move. I wouldn't consider a break of structure on Bitcoin until we broke probably this high here would be a break of structure. This, I think, is just change in state of delivery, though this is a continuation. So I guess it could be considered break of structure on the 4-hour. If you guys keep in tabs on James Wynn, I don't know if you guys know who James Wynn is. He just added to his Bitcoin short. Where is he? Right here. He added to his Bitcoin short. Where is his? Yeah, right here. Added more to my short here, and he's like, what is this short? I think he's got like, I think he's like up 70 million on his short right now. Yeah, my short is up over 70 million. He's not doing too bad, but now it's at 105K, so now he's probably up like 35 million. So we'll see how he does. But that's like one of the fun guys to watch. You want to see a degenerate trading, high leverage? Look at James Wynn, and he's in a short right now. He got liquidated for, I don't even remember how much. It was several million. He got liquidated for on this move to the downside. Yeah, this move here on this day move here, I'm pretty sure it was this. He got liquidated and got wrecked, and now he's shorting the market. I don't know. This guy's crazy. I don't think it's going much lower than where it currently is at. I could be wrong, but Bitcoin looks pretty strong where it's currently at. If we do get a good reaction off London high, and we do get a bearish inversion, I think potentially a target could be London lows. It could be like one of the first targets that maybe we go after. Or actually, well, I guess actually technically some of the first targets could be these lows down here on the 5-minute. Let me change that color. I like this color. Some of these lows here, all these like equal lows almost. They're not really exactly equal lows, but they're pretty close. All these little wicks probably hold some liquidity. And then if we can get some displacement off these lows, my guess is we could target at least London low. And then if it really wants to retrace today, maybe get this day low or day high, previous day high, and Asia low down here. But market does look pretty bullish, so I would be going against the trend pretty heavily. But it doesn't mean that price can't, you know, have that move to the downside. Because I have seen it, even in the most bullish markets where price will have a retracement like that. You can catch a good retracement. But my first target, if I were to let it run, would be London low. Or sorry, these 5-minute lows down here, all these wicks down here, because there's a lot of liquidity price sitting at these lows. From New York session as it opened up, probably a lot of liquidity underneath here. So if we could target these lows, I could see us displacing to London low pretty quickly, because I'm sure there's probably a lot of sell orders down on these lows down here. Really, I could probably draw a box. We'll draw a box real quick from this one to that one, and we'll delete all the lines. So we'll see kind of like how price reacts once it taps into that area of resistance. I'll put a text thing. through. So my guess is if we are able to get an inversion here, if we can make it down to these lows, there's either going to be a lot of sell side liquidity or buyers could step in to push the market back up. All right, nice. We got 107 people in here this morning. Hope you guys are having a great day. We're looking currently, if you're wondering what asset are we trading right now on the screen, we're looking at Nasdaq, the Nasdaq. That's what we're day trading right now. We're day trading with some prop firms, Apex and Top Step. I am a Top Step fund trader, so hopefully that we can get a good short here on Nasdaq if it's able to invert this fair value gap. All right, there's a phone call coming in real fast. I'm gonna just see what this is on the live stream real fast. No, it's about it. This is what it did last time. Tapped it a couple times, then all of a sudden it just decided to bang. Yeah, literally. It went bang, then bang. It's like, hey, I'm going to make you wait all day, then I'm just going to let him smack for you. You were patient, young Padawan. Good one. Yeah, I'll be doing 10 on my short and 15 on my long. Yeah, it will. I think it'll go down, and then I think it's going to potentially do like exactly what it did yesterday. It could go deeper down today, because after basically just going up pretty much for the last day, it could see a good correction right now, but it might not, because it's pretty. The market's been waiting for it to be this bullish. Yeah, you might. I don't know. Last time you left, it literally did it right away. What if you DoorDash? Oh, I never DoorDash. I've actually never used DoorDash. Yeah. Oh, I know. I was starting to get a little hungry too. Today again, the 1 minute would have given us an opportunity. It did it yesterday too. Have you? Yeah. Yeah, like the 1 minute did a big candle down, then inverted it. Would have given us an entry, and that one would have been good this morning. But there's a lot of inversions that happened after that happened. So it's like there's a lot of noise in it. Right, is that the 930? That's a 1008 candle. Is it? Yeah, maybe do it. It doesn't look like it's getting close to inverting yet. It literally does. All it literally takes is one. I know, that's like the hardest thing, huh? It's like, oh, do I leave and go do it? All right, so if this high fails to displace this, I think soon, because all right, it's kind of showing a typical model. Like this is a great example up here on the London high, right? London high, you see it push up, you see it push down a little bit, failing to displace the high that it created to the left. Instead, it sweeps liquidity, and then what does it do? Inverts a fair value gap, pushes down. So right now what I'm seeing on the charts, I think it's going to do essentially the same thing that we see over here on the London high, is price will come up here, make this high here, right? So we have this high here that has been formed. Price could come up and tap into this high. Let's get my drawing tool. Price could come up into this high, then displace down and invert, or it could come even a little short and then come down and invert. But I think what we're going to see is that price is going to fail to displace this high, come down and invert this fair value gap. Now, if price instead begins to displace the high, right? And actually more pushes through, candle closure above, retest, then continuation, we might not get an opportunity. Now, maybe we get a bearish candle that creates a fair value gap and then inverts that to the high, which would be great. But if it continues, we might not get a trade today, which would be a bummer. So hopefully we can grab a trade today with this. Once you start seeing bearish fair value gaps forming, that's when you could probably be prepared to then take the inversion. That it's probably most likely that the inversion is most likely coming at that point. I would love to see a sweep of liquidity up here before we invert. Because then that gives me a better signal that, hey, if I put my stops up here at this high, if the liquidity has been swept and then it pushes, most likely price will not come back up to that high to sweep liquidity again, and that I'll be safe to hold this position till TP and not have to worry about getting, you know, a sweep of liquidity and taps me out or anything like that. So. I think that Powell meeting is going for another 2.5 hours. There we go. Tapping into the liquidity up here. Let's see what it does here at this high. Does it displace through it? Does it push through it and have candle closures above? Or do we see like a wick off and then it pushing down? If we see candle closures above and it begin to push, it's probably going to continue to maybe this weekly high, which this weekly high is all-time high. So my guess is maybe we don't get the rejection off of this high. Maybe price will run up to all-time highs, and then that's where we see the rejection. But as of right now, we have no entry signal to take along, for me at least. We'll see what happens in this candle in the next 2.5 minutes. If I see this candle close, you know, below this red line and give us a nice big wick, then that would kind of give me this kind of signal, right? That right in here, what London did, right? This signal right here, where price came up, made a high, started to reject it, pushed back up, swept liquidity, then rejected off, creating bearish fair value gaps and giving us an inversion here, right? Getting inversions, coming back up, and then as you can see, pushing it down further. So hopefully we can get that. Oh, let's just do this. Some people do that. Some people like say if this candle closes with a big wick off the high, they'll put like one in. They'll say, hey, I feel like, or you look at the 1 minute, right? All right, it looks like maybe if the 1 minute inverts that fair value gap that it did, all right, it looks like potentially it's going to go lower, and then maybe we invert the higher time frame fair value gap. So they'll put in like a one or two, and no. But that 1 minute candle actually looks pretty bullish. We'll see. Let's see what it looked like over here. Yeah, that looked pretty bullish, and then it just rejected it. So I'd want to see this 1 minute probably invert the fair value gap off from this high. I don't know. They're not on. They don't stay on this long. They literally only trade until like max 8 a.m. Like so an hour and a half in the market, and then if there's not something by then, they're done. They only trade in like the first hour to 2 hours of the market. Yeah. It's because that's where so that's like considered what's called a kill zone. So that's where like you'll get the higher volatility moves. And so for them, if they don't get the higher volatility moves within that hour to 2 hours, that like they call it the sweet spot, then they're like, I don't care about if there's a move later in the day. I don't want to sit here all day. But yeah, typically you'll get at least one move in the morning. Like early, like right when the market opens, but lately it hasn't been that way. Yeah, try it. Put your stop loss at the top of that the 12:26 a.m. candle. Yeah. I just put just do small, like max 3, like max like I guess you could do 5 probably. Let's see what 5 would do. If you let's see. Sell limit and you put say at the inversion, stop loss up here. With 10, you're risking $345. It's not too bad. But you you TP if you're going, I mean, just to the inversion of the 5-minute, you're looking at making $500. If you go like to the low that I'm talking about in the 5 minutes, you're making $2,300. Yeah, I mean, it's a risk. You risk getting stopped out for sure, because on the 1 minute it likes to sweep liquidity beforehand, but it could work. Oh, is there a fair value up there on the 5-minute? Oh, there is. The smaller it's a little guy. But there's a fair value app if it inverts that. Let's see if it creates a fair value app here. That would be sick if it inverted this high up. Or had a fair value and it inverted there. Oh my gosh, that'd be a killer trade. I'll put 10 in, and then if it inverts the next one, add another 5. Yeah, it's looking good though. We just need this fair value gap to hold. Yeah, like if it closes like it is right now, oh, that'd be beautiful. Fair value gap. Little doji, and then it just like next candle's just like a big old bearish candle to the downside that inverts. I just inverts it enough, and then the next one is just let's go. Give us that fair value. Out of what? Explorers? I don't even know that. Oh, like the recruits, like people who are training. Oh yeah. Oh, it's Livermore. Alex McNeely? Huh. Huh. Hey, we got that fair value gap and a little doji candle. Here it comes. Let's go. We've been patient. Do you only use 5-minute fair value gaps for your strategy? Yes, Slayer. I only do 5-minute inversions on the fair value gaps. Now, we are looking at 1 minute because 1 minute, like this morning, if we were kind of paying attention to the 1 minute down here at these lows, there was a lot of inversions. There's a lot of inversions that happen, but with the 1 minute, it's hard to separate the noise from what you should pay attention to because there's a lot of fair value gaps inverted, a lot of movements, so on and so forth. But if you would tie in the high time frame, right? So if you look here, there's a if you look here, right, big push down, this 1 minute push up, a 5 minute fair value gap formed, which is this green box. But then look how the 1 minute reacted to that 5 minute, right? That could have been an entry signal, put stop losses down there. So I am kind of interested in starting to look at the 1 minute because you do get earlier entries, but there's a lot of noise. So I want to try to create some back testing models to see what can I create with the 1 minute to potentially get earlier and better entries to get like those bigger moves. But I just got to create something. I'm not ready for the 1 minute yet. But my 5 minute though is locked in and it's pretty solid. So I just stick to the 5 minute right now. And that's what I actually execute on, is a 5 minute inversion on the fair value gap. So come on, price, rock it down now. If this candle closes like this on the 5 minute, I think it might continue to the upside. We'll see though. Yeah, it could. Yeah, it's breaking the highs to the left there. Yeah, this actually could probably go to the weekly high. Dang it, that sucks. That's all-time highs up there. We'll see. Come on. Give us a retracement first. Did Powell say anything bullish? Not really. Powell didn't really. He's just getting questioned by all those people in that room. And honestly, a lot of them were asking pretty stupid questions. So, I mean, I don't know. Actually, I could be totally wrong. Maybe they're not stupid questions. I don't really know much about that stuff. A lot of what it sounded like, just kept saying the same thing over again. Like, I don't respond, or I don't, say things to certain things like that. And then it's just kind of the same answer over and over again, I feel like. So I didn't really hear anything crazy. He did. The one thing I think he said that was probably the best thing for a market was for a market that we care about is the crypto. He did mention that banks are free to do anything with crypto Like they are not regulating that they can't use or participate with crypto customers or things like that. And did talk about like stable coins and stuff. So he did mention some of those things, but not really anything else. He's hinted at if like unemployment or like is it employment gets worse or labor gets worse, he could potentially cut rates. But right now he has no intentions of cutting rates, which that's kind of, I think, what most people were like looking for him to say. Like, would he in the next 6 months cut rates? What it sounds like, he has no intentions to cut rates anytime soon. I think that's what most people were wanting to hear or trying to hear. And yeah, he did not give any information on that. So, all right, with this candle closure that just happened on the 5-minute, it looks like price is probably going to head up to the weekly high. And it's probably going to go to all-time highs, actually, on 22,426.5. Which is a bummer. I wish there was a fair... Why didn't it form a fair value gap for us? You know? Why couldn't you have done that for us? So we could have inverted and take part in this. But instead, nah. But on the 1 minute, it did. Wait, did it invert any fair value gaps? Yeah, it did. On the 1 minute, it did. See, that's why I'm like, oh, maybe I started looking at the 1 minute. Oh, I do see this on the 1 minute. So 1 minute pushed up. 1 minute had a unicorn here. Respected that unicorn after tapping the 5-minute fair value gap. Push up, unicorn created, tapped in the unicorn, stop loss there, boom. There's some people in the mentorship group that they're really good. They spot those unicorns, and that's all they do. That's all they take is unicorns all day long. And they're really good with them, like super high win rate, super high RR. But yeah, right here, you could have done right here, boom, that, and then you have this. So that lineup, this fair value gap with this breaker block is considered a unicorn. And so then you would set your limit order on the top of this breaker block, stop loss is at this low, and you typically, so what they do, they target 2R. So from the top of this breaker block, they would, so wherever it first tapped them in right here, I guarantee you they took this trade this morning. Boom, and then you target 2R. He's probably already out of his position. Dude, this magnet is driving me crazy. Yeah, they're probably out of their position already. But that's essentially what you do with a unicorn. Maybe, I think that's, if I were to do the 1 minute, that's probably what I'd do is the unicorn. Because it's very high probability and you can separate the noise with it. But then also you had like this bearish unicorn over here. You know, yeah, this bearish unicorn, which tapped in on this guy. That one wouldn't have played out, but this bullish unicorn, right? I'd probably, if I were to pick one, probably go with the bullish unicorn over a bearish unicorn because it's going with the trend. But yeah, let's say price is gonna, yeah, price is doing really well now. Yeah, look at that displacement. Maybe another fair value gap formed here. Yeah, very small one. Another slight fair value gap. I'm interested to see how we react now to this weekly high. That's probably where we're headed. We could also react to, let me go to the daytime frame. There is this body here. So we're tapping into the body of that candle. See how we react there, but I think we're going to go to the weekly high up there at the all-time highs. This gets me excited. The market is looking good, back to normal. Kind of bummed we didn't get a trade opportunity this morning to catch this move, but it is what it is. You're not going to, I mean, maybe you're not going to get a trade every day. But this gets me excited for tomorrow. I was excited today, but with the whole red folder news with Powell, that just kind of ruined the morning. Tomorrow we have final GDP and unemployment claims at 5:30 a.m., so before the market opens. Oh, wait, no. Oh, shoot. He testifies again tomorrow. Oh, gosh. I think tomorrow they do the same thing over. Yeah, that's right. They do it for 2 days. Dang it. Hopefully that doesn't ruin the market again. I am debating on opening up a Bitcoin position here. I like the way it reacted to on the day time frame, this weekly gap. I like the way the 3-day looks here on this. I think I'm going to open up another Bitcoin long here. I'm just gonna do it now, because on the 4-hour I've gotten confirmations on inversions and break of structures. 1 day I got that confirmation of the bounce off the fair value gap. So I think I'm comfortable. And with the now the forecast of everything, like the war potentially being over, the semi-annual monetary policy reports being done, things getting back to that bullish trend. I think our position was great that we originally have a Bitcoin, but like I didn't know that Israel and Iran, was gonna bomb each other and start this potential war, which then got us stopped out. But it is what it is. And now that things are kind of like slowing down, I think we're good. I'm gonna do it. I'm gonna take it, and I'm just gonna kind of go for. $2R here. Okay, and I'm gonna be also later today checking in on some of the other currencies like XRP, Solana, things like that, to see if now that the war stuff has settled, are they gonna present some long opportunities and get back to normal on their charts too. All right, looks like an inversion might be coming here on the small fair value gap, but it doesn't matter the size of the fair value gap. That's something to take note of here. We also have entered into like this wick block here on the higher time frame. So this is an area of resistance we might start seeing here near this all-time high, near this body candle of the day time frame, and we might see some retracement here before we hit that all-time high. But just looking for that inversion. If we get the model set up, we're gonna take it, and yeah. All right, 57 seconds on this candle. Just in case if it decides to like rip down, I'm gonna get it set up just in case. Sell. As it might actually invert this guy. Getting close. I'm gonna zoom in here. I'm gonna put stop loss at. Actually, we'll leave it right now. I don't think it's gonna invert it. Tapped into it though. Nope, did not invert it. Maybe the next candle will. But we have our limit orders prepared and on the side, just in case if it does. Yep, there we go. Inverting that candle, so we're gonna get ready to potentially take this inversion here. Sell limit would be right around that red line. We're risking about $470 on this trade. Not too bad. I will be taking a partial TP on this position, so if we're able to hit partial TP, I'll be only closing out 5 of my limit orders, and then hopefully able to hold the other 5 if it decides to run down to these 5-minute lows or maybe even London low after tapping into these highs up here. I don't know if it will go down that far, but if we hit TP, a partial TP, we'll move stops to break even, and then hopefully can ride it out further, kind of like what we did yesterday, where we got to ride out the profits a little bit more than we originally had planned for. Sometimes it cuts your profits a little lower because you didn't take full TP, but most of the time you get a little bit of a run, and it plays out pretty nicely. Maybe it won't display. Maybe it won't invert. We'll see. We still got 3 minutes left on this candle. A lot of time. Right. 2 minutes left on this candle. I'm just getting all my, because I trade on 3 different ones, and so I'm just trying to get them all set up and prepared so that I can execute quickly and efficiently on all these different positions. Let me double check my TradeSyncer. That would suck. Yep, TradeSyncer looks like it's working properly. Okay. All right, Zachary, I don't know if you're there. We're probably going to get this trade in here. If it closes below my OTEs, I'll just move my limit like right where it closes and then hopefully get tapped in like immediately. But this will be the one I prioritize first, and I'll hop over to the other ones. So it looks like in the next minute, maybe this might be where we get our OTE. We'll see. I'm selling 10 contracts on this one. No worries. Yeah. Yeah, I'm not making much money on this if it does invert it. Oh, wait. Yeah, no, it's not too much. I make like 270. Yeah, I'm doing 10. All right, 20 seconds. And seconds. All right, I'm putting my sell limit in. I put it like right on the candle closure because it closed outside the OTE, and I'm in. I'm gonna just kind of watch this for now, and leave it at 10. But if I start seeing it push down, I'm gonna change this to 5, just in case if it decides to have some crazy wick up, it'll fully stop me. Oh shoot! I haven't entered in, these guys. Alright, I am in across all my accounts. Looking good so far. I like that. I want to see it wick off there. I'd love to see some bearish fair value gaps start forming to the downside, like some displacement. If we invert this second fair value gap below us, I will be adding another 5 contracts to my position, putting me at 15, and then my partial TP will be a total of 7 I will take off on my partial TP. Alright, all of them are set up and ready to go. Yeah, change this to 5. Hopefully. Alright. My TP is at 5 now because I'm seeing some displacement to the downside. So if we do tap in, I'm only closing 5, and then I will move my stops to break even on this if we can get that TP smash. That'd be awesome if we can invert on this candle here. Two minutes left on this candle. Let's get TP in 1 candle. Come on, we've been patient. Can we get it in 1 candle? That'd be awesome. That would be lit. TP in 1 candle, dude. Come on. We're almost there. Oh my gosh. Let's go. It's inverting. If we invert this, I'll set a sell limit for another 5 contracts on mine. Zachary, you won't be... TP's at the 2. On the... Shouldn't be. Yeah, it is. On the one that inverted? Yeah, it's dead on 2. Yep. Mine's dead on the 2 line. Oh, you're a little lower? I think you're at 2.5. Yeah, 377 is 2.5 for me. Man, it looked like it was going to invert that fair value up. Now it's kind of bouncing off of it. We'll see. I don't have any reason to close this position, and I will not close this position. So for me, the only way I close this position at this point is if we get stopped out. That's the only way I close this position. Unless we start creating bearish fair value gaps or something, and then that inverts, that's the only way I have it closing. So right now I'm just going to be holding this even if it's in drawdown. Dang it, I thought we were about to invert that in one candle. Nice thing is the distance of where the fair value gap was inverted and where our stop loss are, we're actually not risking too much. We're only risking about $365. So that's typically a very small risk for me. My normal size, if I'm risking a full R, is over $1,000. So if it does happen to get stopped out, it'd be a bummer, but it's not, it wouldn't put us too much into the red. I'm so bummed that candle did not invert that fair value up. It came so close to TP too. Hopefully this price action to the upside slows down a little bit here. What would be nice is if maybe it creates a little bit of a bullish fair value gap and then we invert that, get a second inversion to the downside. But we'll see how it goes here. I'll probably watch the 1 minute, see if the 1 minute can give us some push downwards, maybe make a high here, and maybe that we can take off some of just, you know, lessen our risk more and more. So if maybe price can start pushing down on the 1 minute, inverting some more fair value gaps to downside, maybe even break this low here, we can move stops down to this high. So if you're someone who's maybe trading and you trade on the 5 minute, you're wondering how do we lower risk in our position as it moves, we can say, okay, we can look at the 1 minute and say, is 1 minute having a change in state of delivery? Is it inverting fair value gaps? Is it having momentum to the downside? And if so, like right here, if it decides to start inverting fair value gaps, pushing towards this low here, we could probably move our stop loss to this 1 minute high. Because if price comes down, fails to displace this low, and then decides to head back up to this high, it's most likely going to then continue bullish momentum, and that'd be a high that the 1 minute shouldn't be breaking above. Now, I'm not moving it yet because it hasn't really solidified a high or done anything really bearish enough to say, oh yeah, price is probably going to continue on its trend to the downside. But we'll see. We'll see if we can get a confirmation on the 1 minute to potentially move our stops down to this high to take off probably another $100 in risk is my guess about. But I just don't want to move it too quickly, because if you move it too quickly, right, price could still want to play around here before it moves down. And you don't want to get accidentally caught in like a little liquidity sweep because you moved your stops too quickly and then you miss out on the move. So it's wise to be patient when you're moving your stops. Let the trade do its thing. I'll probably wait and see what the 1 minute does in this 5 minutes. So there's 3 minutes and 40 seconds left, or 30 seconds left on this 5 minute candle. So I'll see what the next 3 1 minute candles look like, and then that'll tell me, can I move my stops down? It looks like we might be able to. Especially if this 1 minute can invert this fair value gap and this one, that'd be great. The 1 minute inverted one fair value gap. I'm not going to move it yet. We still got 3 candles to come in this 1 minute. Just want to be a little more patient here. This move to the downside on the one minute didn't make a single fair value gap. Even over here, not a single fair value gap. And if the 1 minute on the bearish side of things can start making some fair value gaps to the downside, that could potentially be our friend and begin showing that price is displacing to the downside. Place a magnet emoji at the bottom of your chart. It usually, let's do it. Right here. Right on TP. Yeah, the magnet. This is the magnet model. So you place a magnet and then price should go to the magnet. It's been back tested. Oh, and then there's also, is it the hammer strategy? Where's the hammer? Where's our hammer? Right here. All right, you. Beat it down. Beat it down. Send it to the magnet. Yep. 2, 1. Perfect. Gotta beat it down. Take this one. Okay. Gotta beat this candle down. This is what the market makers do. You just hit it downwards. Make sure it respects that fair value gap. And you beat it up if it doesn't. You just want to keep making sure that it hits it down. See, look, it's working. Hammer strategy working. There we go. Let's make sure. Yep, look, working. Beat it down. Beat it down, invert. Perfect. Hammer strategy and the magnet. It's working. Told ya. Love it, Slayer. Thank you. Nope, nope. It's not listening now. Just gotta beat it down. There you go. Keep beating it. 3, 2, 1. I think it just inverted. Nope. Got close. Oh, I'm not being a good hammer. Maybe a little bit more. Nope. Gotta hit it. Gotta hit it. You want to see this candle invert. Beat that thing. Beat that thing. Stupid. I had like hurting my eyes. I'm liking this though. Price made a fair value gap here to the downside. 1 minute came into that fair value gap, rejected, had a little push. So I'm 1 minute's not looking terrible. Maybe a second magnet could help. I love it. Get more of those magnets down there. Get more of them. Pull. Oh, maybe we add a little. Yeah, add a little. Oh. What was I gonna do? I was gonna add. Two down here. Little money bags. So it knows the money's down here, right? You tell it the magnet, money's down here, you need to go down here, not that way. So it's not confused. And then you bully it a little bit. You say, if you come up here, you're a clown. And yep, now it's impossible to go up. It was looking so good on that first 5 minute. Yeah, it looks pretty lame right now. All right. That's it. I realized I only put like $1 trade on the other one. Maybe a second. Yeah, now it's a. Yeah, price breaks above this 1 minute high. Probably not going to be good for us. Might get stopped out there, but we'll see what price does. Money bags. Magnet. If we can get on the 5 minute, like a change in state of delivery to say this low, right? Say price decides to come down, have a candle closure above this this low here. I'd be open to moving my stops to the wick of the 1300 candle on Nasdaq. But right now, just not showing any signs of like we can move it yet, because price can still come and sweep these highs or mess around up here a little bit more. So I'm just waiting for that confirmation that says, hey, you could probably move your stops now, because if price comes back up to this and breaks it, it's going to go much a different direction. So right now, the only place that we would be completely wrong is if price came all the way up here, tapped us out here, and then continued on. That's the only way we'd be pretty much completely wrong with our trade. And that's why it's important to just kind of watch what the candles are doing and not moving it too much, because price sometimes likes to play around before it gives you what you want. Looks like we might be getting stopped out. We'll see. We'll see what happens kind of at this high again. All right, that's not bad. If we can continue pushing back down. Love that. Come on. They might have patched the strat. The model makers might have patched the strat on that one. Or market makers, not model makers. Market makers. I'm just bummed that they're not a single bearish move on the 5 minute has created a fair value gap that we can actually enter for the bullish momentum if it does go up. That's the thing I'm probably most bummed about. Like, I don't even care. I'm just like, why is it not giving me my entry model so I can get in? This actually isn't looking too bad. There's a minute left on this candle. If this momentum that can continue to the downside here and can continue pushing down, it might not look too bad for us actually. But we'll see what happens in this next minute. See what this candle does. If this candle can fail to displace this high here and push down, that'd be great. That'd be really good. Because see the 1 minute, right? Push down, made a lower high, push down, failed to displace that high. And if it can push off of that and continue to the downward momentum, we're probably actually looking pretty good on this position now. Yeah, if this can push here. Maybe break this little 1 minute low. We'll see what happens though. But I love the fact that this 1 minute failed to displace this high. Not looking. Okay, that's not bad. So 5 minute. Came up, wicked, made a doji candle. Let's hope that that momentum can kind of continue. And maybe we can get a change in state of delivery off this wick low here on the 1315 candle. Get out of drawdown. It's always the worst when you open a trade and then you're just immediately in drawdown. Like, that's just always like, it's never fun to do that. Looks like all the positions work today. Yeah, we're all in. Cool. We're all in. Perfect. 10:20 a.m. Oh, there we go. There we go. Just please don't do a move like that to the upside. Yes, perfect. Oh, let me change this real fast. Ooh. Okay, that's perfect. I'm gonna move stops down. Once this oh wait, we got 3 minutes. Let me see the 1 minute real fast. Yeah, I'm gonna move stops down to this 1 minute high. Zach, I'm moving my stops down to the high on the 1317 1 minute candle. Looks like TP is about to get smacked. Let's go. TP smacked. So partial TP is hit. Stops are getting moved to break even. Can't move your stops. Oh, because they disappear. So then put on your entry point, put a buy stop of whatever's left. Does that make sense? So you put a buy stop of whatever you have left on the table. Yeah, you should have so good enough. Buy. Just click buy. You don't do a stop loss or nothing. Just click buy, and then it'll put the stop order in for you. Yeah. Yeah, you don't need to put a stop loss or anything like that. No. So now we just let it run, and then the only way we'll close this trade is by the buy stop getting hit. So actually, I'm about to. The buy stop is your profit. So like, hopefully this runs right and it keeps going, and then we move our buy stop to like fair value gaps. Yeah. Yeah. So that's how that. I'm actually gonna potentially add to my position, add another 5 here if we can invert this next fair value gap. And stops will stay at the previous entry. So if we get a here, let me do this. We have a minute, 30 seconds. If it inverts this, I'll be adding 5 to my position. Sell them at 5. And stop loss will be at entry of current candle or current position that's live, and TP will be at 2. And we'll add another 5. Yep. If it inverts, it has not inverted yet. And it looks like we're going to get the inversion here. That'd be awesome if we can double up on this and it continues ripping down. They can't patch it. They can't do it. It's too good of a strat. Maybe it'll fail. We'll see. So we're up so far for the day, 166 bucks. Hopefully, if we do get this inversion, it you know, is another winner. no inversion there. Might come on the next candle. I'm going to clear out that order and see if we can get a good little move here. But I'm loving this. I'm loving this. Looks great. We could get stopped out at break even, which would be a bummer because we kind of technically would miss out on some profits. But hopefully, the idea is that this position could actually run, and maybe we target, like I said, this resistance and sell side of liquidity down at these 5-minute lows, or maybe we even go down because New York session has not tapped into London low. So if this move here could even come down to London low here, that'd be a killer trade. If we can catch it, but we could get stopped out here at break even and not be able to catch a runner further. But if we do get stopped out, what we might get left with is a bullish or bearish fair value gap. That if that, what'd you say? Did it not work? So I did get stopped out on my position here at break even. So now I want to see, do we get left with a bearish fair value gap? And then does that maybe get inverted? Or do I wait for this one to get inverted, and then do I get another trade opportunity? So I'm gonna just see what happens here, because it looks like I get another trade opportunity either way. And I'm gonna try to take them. What? I don't know how it's not mine all. Is your connections all good? You can't look at the TradeSyncer P&L. It's never accurate. You just, if you want to really see, you got to go to TradeEvade. Or you just go to your Top Step dashboard and check your Top Step dashboard. Because I bet all your trades hit the same. So okay, this is weird. My other accounts at break even did not get topped out. So I still have 2 trades actually open, but this one had a higher fill on my entry, so I actually did get stopped out on this one. But I have 2 other trades still open on other accounts that are actually still in play. So kind of a bummer that this one got stopped out, but we'll see. Me? Oh. No way. Is this about to invert it too? I get stopped out and then it inverts it? That sucks. That's all. If it inverts, I'm doing it again. And all my other ones I'll add to the position. Stop loss for me on this one if didn't invert. Dang it. Stop loss for me if I do get the inversion on that down to the downside there. I'll put stop loss at the top of these candles here where this fair value gap's at. But we might get a bullish inversion here, which would actually be kind of what I'd prefer, because I think we might target all-time highs today. We'll see. All I care about is does the model give me the entry, and then I take the entry. All right, that's closed out. Looks like we might get a bullish inversion here on this candle in the next 3 minutes. Looks like I'll be taking that bullish inversion. Can't be doing what every day. Okay, so this one I'll be taking 15 M&Q if it inverts. And it's definitely with trend. So we can get an inversion here. This one should be pretty nice. TP would be just outside of all-time high. So hopefully we can get a little break of all-time high here if it does invert. But all positions now have been stopped out. There's no positions open. Yeah, if it goes. Yeah, oh, is it not? I'm about to set it up. I'm setting it up on like 3 counts. Just to get it on. I just haven't done it on the trade by 10. 15. Stop loss will be at the low down here. TP will be at 2.5. This would be a really good trade if this one smacks. If this one hits, we're making almost $1,000. It would be up over $1,000 on the day if this one can actually play out. If we get a trade here on this bullish inversion, I'll be taking it, and this will probably be the last trade of the day. $40. See if we get that inversion. I'll be taking a partial TP at that high if we do make it up to that 2.5 standard deviation. But right now I'm going to keep it at full just so my stops are at full. $20. Come on, invert it. Give us the inversion. Come on. It looks like it wants to. Looks like it wants to, but will it? Three, two, All right, maybe next candle. I'm going to keep my orders up and ready because it looks like it wants to invert it. We'll see if it actually does. But for the day, I'm up 172 so far. 172.60. You mean TradeSyncer? Yeah. Yeah. I think we could get an inversion here on this candle, so might get a bullish. I would really like to go bullish here. I think we're going to target the all-time high. I think that's something we could hit. Chat, something that I want to be a good example here on the trading that we're doing is not getting stuck in a bias. Like when you first get that inversion, sometimes what you can get stuck in is like, oh, it's only going to go down now. It inverted. But you got to be able to let the charts, you be liquid and fluid with the chart of saying, okay, now it wants to go up. Let's be okay with immediately switching to going long. And it's hard for people to be able to switch like that and go short then long then short, like to be able to flip. So if you're able to be someone who just is mechanical with your model, take it as it comes and take it what it gives you, it'll ultimately play out well for you, I believe. Kind of hoping this candle, if it doesn't invert, I'm gonna go run to the restroom real bad. I gotta go pee. Yeah. All right, let's see what happens in this last minute. See if it'll give us an inversion here, or if it just will chop around maybe for one or two more candles before it does something. Because we literally have an inversion. One below us that we could do, or one above us, a run that we're currently sitting in that we potentially could take advantage of. So it looks like we're going to get an opportunity either way. Okay, 10 seconds, and it does a doji candle. Sick. Maybe not. Oh my gosh. Oh my. All right, I'm gonna go run in the restroom real fast. Okay, well, it looks like all I had to do was leave. Okay, okay, let's get this set up. Buy limit up here somewhere. 2.5. All right. Making a little less money on this move now, but still, if it plays out, it'd be good. Right, 2 minutes. I think we're I think we're definitely gonna get an inversion here. But we've also seen it not do it. So I'm gonna lower risk a little bit on this. I'm gonna move stops up to the what candle is that? 1325 wick. So we're risking about $700 on this trade. Not too bad. It's a little bit less than like a full R risk. To make, we're risking about 700 to make about, if we did a partial TP would make us about $330. But if it could run, who's to say what it could make us? Looking great though. I'm loving that we finally got an inversion. All right, last minute. Let's see how this closes, and see where if we could put our. I think my buy limit will be at 786. I don't think it'll close below that. It could, but oh my gosh, dude. It's getting really high now. Right, 30 seconds. $20 seconds. See how this. See where this kind of closes. All right. Might be putting it right on price close. Yep. put my limit right where price is at. See if we get tapped in. All right, we're tapped in. And 15, market size 15. I'm gonna put stops actually to the bodies of that low instead of the wicks. Price shouldn't come back down all the way down to that now with that displacement candle and this push. It should hold that line. So I'm gonna just take off a little bit more risk. Now we're risking, because after that push, it's still around $700 we're risking on this trade to make a good amount of money. This one would be, if this trade played out, this would be a pretty solid trade here. Limit sell, limit sell 7 on the TP. That's 2.5. So if we're able to hit that 2.5 mark, I will be limit selling 7 of my contracts and then holding another 7 just in case this thing decides to start having price discovery and ripping up to the upside from the weekly high of up there, which is all-time high. Yes. See. Yeah. All right. Oh, I didn't on this guy. Perfect. Yeah, it could be a liquidity sweep, right? But so that's what's kind of important with the model. Like, it might look that way, but you got to remember it inverted that fair value gap after bouncing off a fair value gap below you. So, it does kind of look like it, but we'll see. We'll see what it does. Yeah, because we could technically, right, be wrong. It could tap into that high up there, and then it could reverse from there. But we'll see how this goes. So right now it's looking pretty good. We'll 2 minutes on this candle. If we can get a fair value gap formed here, like what I'm seeing right here, if this fair value gap can hold, I'll be moving my stop loss up to the wick of the 1335 candle. So just in case if the fair value gap wants to get tested, it gives a little bit of a playroom, and then hopefully it can respect it and keep going if it does tap that fair value. It could be a breakaway gap where price doesn't come back to it and then just keeps going. Yeah. Run. So everything's looking good right now in this position. Let's see if it sticks that way. That'd be 2 back-to-back trades, and then we can call it after this trade if this one wins. I would love it if we can at least get that partial TP up there, move stops to break even, and then just kind of let it do its thing until like market closes at 1 p.m. in like 2 hours, 3 hours. Oh, wait, what time is it? Oh, 2 hours. Holy smokes, it's already 10:50. All right. All right, 8 seconds. Okay, it looks like we're gonna be able to move stops up. I'm moving, once this candle closes, moving stops up. Okay, stops are going up to that wick. Modify order. Modify order. Let's see, did that work? Click on TradeSyncer. Yeah. All right, TradeSyncer's looking great. All the positions, all 45 accounts are doing great. So crazy having that many accounts trading at once. Hey, this trade smacks. This is a good day. This would be a good day. This will put me in the green from last week. I'm a little bit in the red still from last week. Man, if we could displace this weekly high and just rip up into price discovery, oh my gosh, that'd be lit. So now we're risking about $500 on this trade. Since we've moved up, we've taken about another $200 off the table of what could be lost. So I'm pretty happy with the risk. If we can continue breaking above and have a candle closure above these wicks, I'll move my stops up to the wick of the 1340 candle, just to take off a little bit more risk. But right now I'm gonna keep it right where it's at because we could get a test of this fair value gap. That's another strat you can, or another thing you can add to the strat. So like what some people do, they'll wait for the inversion, wait for an inversion, then wait for a fair value gap, and then put their order on the fair value gap, and then they do that. So, but if you look at it, our entry is pretty close to that fair value gap, so you're not really saving. What you're saving yourself is the headache of being in drawdown, potentially. All right, it's looking good. 50 seconds. Let's see if this candle can we displace this weekly high? That would be awesome if we could displace that high. And then we'd literally be in price discovery with Nasdaq. Let's go. And there's 120 of you in here. Let's go. Huh? Right. Right now we're up about almost $400 on this trade. Not too bad. If we can displace this high, we'll be up over $400 in unrealized gains. So that's not realized, but 2 for 2 maybe, Slayer. I think we're gonna get 2 for 2 today. I'm liking that candle. It made a little bit of a higher high on that wick. Hopefully it can continue that momentum. Ideally, if what you don't want to see is wicks making a low from the previous wick, and you want wicks or candles making higher highs, right? So that's ideal. Or what would be great is if we can get a displacement candle that creates a fair value gap, and then we can move our stop loss into profit near that fair value gap. That would also be ideal if we can get something like that to form too. Let's see what email I got. All right. There we go. I'm liking it. It's made some equal lows there. Hopefully we can push up. We haven't really tested the weekly high yet on that line. We've gotten really close to it, like very, very close. We haven't really given it a good test because there's probably some liquidity from the shorts up here. And then if it can tap into that liquidity above this high, hopefully we can get some fuel and really displace this sucker to the upside. All right, see, can this 1 minute, can it push it back a little bit? Then we continue that. The thing that I don't love is that our partial TP is up above all-time high, right? So like, will we hit mathematically with this inversion? It says it should go to this level. Now, will it? Because we are at the all-time highs? I don't know. We could see some resistance here. We could see some retracement or reversal. But I'm hoping that we can get some price discovery here. And I'm hoping that if there is liquidity at this high, this all-time high, that we can get that fuel and displace above, targeting our partial TP up there. But we could also very much see a reversal here at this weekly high, because it is all-time high, right? That's a psychological level for the market. And people, will start to take profits if they have, long positions open that have been long open for a while or whatever it is. That was at the 2.5, yeah. So mathematically, right, with that inversion, that's where we should go. Now, will we? I hope so. I want us to give us a good solid test on that weekly high. So I want to get a good test on this and see what, because I think if we get a good test on it, you're going to see displacement, like where it pops up. There we go. There's a good test. Let's see what it does here. Come on. Push through. Push through. See what the 1 minute is looking like. 1 minute's looking good. If I can get on the 1 minute, if we can get a 1 minute break above these highs and a closure above this weekly high, I'll probably move my stops at this 1 minute low, lock in profits, and then we'll definitely end the day. Oh, see? All right, I'm gonna move my stops up to that 1 minute low. So at least in the day, we're gonna end over $300 in profit, and we should be at a good target. So hopefully, Dagger, do you know where I put my stops? You see what I'm talking about? Yeah, I'm just putting at all those 1 minute equal lows, because prices just closed above that high, so it shouldn't come back down and break below that. Yeah, so we're like, yeah, we'll be up like at least 300 for the day, which isn't bad. Oh, is it like 100? There we go. So which is really right at these 5 minute lows. So hopefully this 5 minute candle can do the same that the 1 minute did. And if the 5 minute can do the same, we're good. There we go. But yeah, how much on my screen it's showing if we get stopped out, we're making around 120 bucks on this trade, which would put me at about 280 for the day, which is great. How's the Bitcoin doing? Bitcoin's up in profit right now too, our position that we opened. I'm gonna move stops up on my thing a little bit to that 1 minute displacement candle that caused that fair value gap. So to the 1400 body, I moved it up to that. And then I won't move it again unless we get some more displacement. So now we locked in almost 200 bucks on that little move. Now we have $200 in profit that we'll lock in on this trade. There we go. I'd be happy with that. It'd suck if we don't, aren't able to displace to the high, but I think we're putting our stop loss at a good spot, because if it does decide to reverse here at this weekly high, it could go much lower. We could get a third trade opportunity, but honestly, 2 trades in the day, both green, might as well just close it on that day. I don't want to chip away all day. Let's see what happens here. It tapped in that high. Let's see if it can continue on the 5-minute or if it's going to start coming back down. Come on. Pop up 1 minute. Push. I think if we can get above these 1 minute highs that are being formed and we really start going, it could move pretty quickly and to some level. We'll see wherever it goes. Because that's the fun part about price discovery. There's no resistance until all of a sudden there's resistance. All right, 1 minute just inverted a fair value gap to the downside. I got it on multiple charts. We could get stopped out here. Could see a little bit of reversal, but hey, it's a green day. Profit is profit. That's almost $400 on the day. I got stopped out too. Hey, that's a dub. What are we at? 356 for the day. What are you at? Not a bad day. Not a bad day. Another green day. Shout out TradeSyncer. All right, that's it for me today. That's all I'm probably gonna do. Tomorrow might be another lame day because Fed Chair Powell is doing that thing again, and so it could be another lame day in trading regards. Like, it's very slow, doesn't give us an entry till late in the day. I kind of hope it doesn't do that. I kind of hope it gives us an entry a little quicker than today did, but I'm very happy with today. That's 2 for 2 wins. Today we got a green day yesterday, and we're up right now for this week. Let's see if it's calculated kind of properly. We're up like, I don't think that's right. I made $356 today. I think I'm up like 11K for today, 12K for today. Yesterday we made 10K, so we're up like 20K for the week. Not bad at all. Not bad at all. I'm very happy with that. Little profits, get good returns. So happy. All right, everyone. That's probably what I'm going to call it for this live stream. Good trading days. Today was a good day. Yesterday was a good day. Hopefully the rest of the week is. And I'm very excited because the market is back to an actual bullish trend. Like, it's actually sticking to it. The war is kind of settled. Tariff things are kind of settling. Hopefully the market, especially for Nasdaq and Bitcoin and all that stuff, can continue on this bullish momentum, making trading easier again. Right now, it's been this last month, like the last 3 to 4 weeks, has been a very hard market to trade in. But hopefully now that we have a clear trend, the market gets much, much easier to trade in. And so I'm excited for, next week, especially. This week, kind of lame because we got the FOM or Powell speaking stuff like today and tomorrow. We have some unemployment on Thursday, and I think that's it for the rest of the week. But then next week, now that the trend has been set this week, next week should be an excellent trading week. Is my kind of expectation. So I'm excited for the way this week will close out and how things should hopefully look for next week. So, all right, everyone, I will see you tomorrow morning. We will be streaming again at market open We'll probably listen a little bit to the Jerome Powell stuff, probably for an hour, and then close it down and then see if we can catch a trade. But yeah, expect tomorrow to kind of look very similar to today. So I'll see you guys all tomorrow at market.